Right, good morning and warm welcome to the BCI Investment Conference, the first of a couple of roadshows we're doing nationally. And from my side, again, it's wonderful to speak to people and actually be able to see them and not a TV camera or computer camera, not knowing what your audience are doing and if they're even listening. Right, we came a long way. I think the last time we had a live-only event was in February 2020. Then we went virtual, and then we went hybrid sessions, and now we're back to live conferences like this. And you'll wonder, the cameras, if we're live only, why the cameras? We are recording the session, and we'll be sharing the presentations with you guys afterwards. There's always something you want to recap on or wonder, what did that guy say again? So you'll get the recordings, and you'll get the presentations, and you can go through it again. So how do you know when you are in trouble? Right. So when you wake up very early on a Tuesday morning, the 14th of February, bright and early and ready for the day and ready to conquer the world, and you make your way to the percolator in the kitchen, only to find a little red envelope and a box with a ribbon. It takes a few seconds to figure out what the hell this is, and in that moment, when it dawns on you that you forgot Valentine's Day, you know you're in trouble. Right. Then confusion sets in, because your brain frantically starts looking for the file with plan B, but you know there's no plan B because there wasn't a plan A to start off with, so it is confusing. Right. But rest assured, today we are not confused. We know exactly why we are here, and our managers presenting here today did a lot of preparation, and the BCI team, to make sure we bring you some very good content in assisting you or guiding you when you deal with your clients' investments or hard-earned money. Right. Maybe before we get the session going, just a couple of house rules very quickly. When you came in, there's QR codes outside. There's a QR code on the screen as well. Make sure that you scan in and register. I know it's a bit of a process, but if you've done that, you are registered, you will get your CPD points. But very important, you need to scan out again, follow that same process. Right. This is a live session, so remember, unlike virtual sessions, we can actually hear your cell phones today. So please check that your cell phone is on silent. All right, behind me is the agenda. So if you can maybe go to the agenda. I'm not going to go through the whole agenda, but it's a terrific lineup of managers. And like I said, hopefully we can provide you with some very valuable content that will guide you in making decisions going forward. Watch out for the BCI marketing mailbox. In the next coming weeks, we're going to be launching the Boutique Manager website portal soon. Tanya and her team's done a lot of work on this, and what will all this be? You already know the BCI website, where you can find all our managers in the fun fact sheets. We're going to step further to create a portal where you can find all the content on all the BCI partners, including recordings and podcasts, notes and commentary and quarterly reviews and fact sheets, and whatever they have, whatever content they'll have, will be on this portal. And like I said, watch out for the BCI marketing mailbox or mail. We'll send that to you shortly. From when BCI was formed in 2014, we came a very, very long way with absolutely significant growth, with assets under administration just exceeding 275 billion. And this is all thanks to you, our intermediaries out there, and the wonderful work being done by our partners in managing assets. So we remain grateful for your support and your continued support, and hopefully we can continue our good service as well in bringing you some of the top managers in SA. From Robert, Tanya, and the BCI team, thank you all for being here today, and thank you for all your hard work and contributions during the past couple of years, and hopefully we'll see you for many more years to come. We encourage you to ask questions, so we're going to have the presentations after each slot. There is 5 minutes for questions and answers. Hopefully we don't exceed the time, but we'll try to keep to the times as much as possible. There will be roaming mics in the audience, so if you have a question that you would like to direct to one of the presenters, just put your hand up. We'll get that roaming mic through to you as soon as possible and ask away. Maybe some thought-provoking matters that you might be thinking of. The risks of a very deep recession seems to be increasing, and there's a lot more talk about recession. This is probably the most anticipated recession that we've seen in decades. But how long and how deep and when it will happen is still an unknown factor. Macroeconomic pathways are elusive, and so many times, and we've heard it very often from a lot of presenters over the years, that don't try to make your bed based on forecasting because it just doesn't work. All right, rather lend your ears out to professionals, good fund managers that can provide your clients with alpha in the various or the different asset class categories. Very difficult to determine how things are going to play out, but hopefully we can provide some guidance as to what the managers are thinking and where they see those opportunities going forward. Heightened job numbers points to a serious economic imbalance with the decoupling of the US, Europe, China, and Japan. So a lot of talks about China as well. And then you have to ask yourself, but how can that benefit emerging markets? Is emerging markets probably the place to go? Maybe the place to go, I don't know. And what about places like SA? Will we benefit from things like that, or China unlocking, especially if you look at our tattered economy, if we can't even get the basics right, like electricity? But you'll be happy to know there's no load shedding scheduled at the hotel today. They do have generators and so on, but if it's load shedding, there's no aircon, but we should be fine. Good. We hope you enjoy the day, and we hope you enjoy the presenters. And like I said, please ask questions, and we'll try to cover as much as we can. Joining us on stage now is Chris Holdsworth and Barry Shamley from Investec Investment Management, looking at the global macro environment and the opportunities that they see and how that plays out in Investec BCI Dynamic Equity Fund. Gentlemen, thank you very much for your time this morning. Thank you for coming through, and the floor is yours.
Thank you very much. All right, I just want to check the mic. Perfect. Morning, everyone. I'm Chris Holdsworth, as you heard. I'm responsible for investment strategy at Investec. At Investec, we take our top-down view very seriously. We spend a lot of time trying to get a handle on what we consider to be the key drivers across the globe and what we think our risk score should be across the business. At the very top of our investment process sits a committee called our Global Investment Strategy Group. It's populated by investment professionals in our UK, Switzerland, and SA offices. The purpose of that committee is to come up with a view on risk, which propagates through our entire business. So if that committee says we need to be risk on, it's up to the other groups and committees below that to decide how we are risk on, but that committee will say, right, we need to allocate more. Or that committee will say, right, we need to allocate less to risk. Now, at the moment, that committee is sending a cautious message to our business. It's telling us that we should be risk off. And it's a committee that we hold in high esteem. The youngest member of that committee has 16 years of experience. The oldest has somewhere close to 50, and there's a range between the two. So they're sending a message of caution. The question is, A, why is that? And I'm going to run through some of the inputs and outputs of that committee shortly. And then secondly, I'm going to hand over to some of the granular considerations to Barry, because even in an environment where there are concerns globally, there are opportunities too. And ironically, those are locally. So let's start off with a broad overview of what's likely to occur over the year ahead. So I'm going to draw your attention to the top row. These are consensus forecasts for various countries that we track across the globe. And right at the top, you've got the US. The consensus forecast at this point is that the US economy is going to grow by all of 0.5% over the year ahead. As you heard earlier, there's a widespread expectation of a slowdown in economic growth. The strange irony at this point, though, is over the past month or so, we've started to see some sell-side houses reverse course. They're saying we've seen some better data than we were expecting, and now we think there's a lower likelihood of recession in the US. And we've actually started to see some upgrades to this growth forecast. A couple of months ago it was at 0.3, now it's at 0.5. And we're hearing more from the sell side that we subscribe to that those numbers should be pushed higher. We don't agree with that. We think this is not the time to be upgrading growth forecasts for the US economy. We look at a range of high-frequency indicators that suggest that should there be a slowdown, or there is going to be a slowdown, that slowdown is starting now. To half answer one of the questions earlier. And some of those indicators, if you look at the number of bankruptcies in the US, in December it shot up, in January it increased further. It's the highest number that we've seen in over a year and a half. It typically increases at the start of recession. If you look at bank lending standards, they've ramped up now. Banks are tightening their credit. Typically that happens 3 quarters before you start to see a material slowdown. We've got a range of indicators, 9 of them that we look at, they're all flashing red. So we expect a material slowdown in growth in the US from this point going forward, and we, as our base case, expect a recession. Europe a bit lower. There's a problem there too. Germany, economic growth this year is likely to be about minus 0.3%. The problem there is we've already seen a material sizable decline in retail sales volumes. It's already down 5% off the peak, and core inflation in Europe is still high. It's running at 5%. So the ECB is still likely to hike by around 100 basis points, as we are already seeing a decline in retail activity. It's not a great picture. So in this sort of mess, and as we're getting into this teeth of the slowdown, where are the opportunities? Again, mentioned earlier, China. China's rebounding, and they can do it because economic growth in China was weak last year, and more importantly, inflation at this point in China is very low. Inflation is running just above 2% in China. The central bank target is 3%. So they can provide monetary stimulus, and we're starting to see that come through now. The credit numbers will improve. And also they can provide general policy changes to improve growth. So they changed their COVID zero policy. They allowed more support for their building sector. So the Chinese economy rebounds next year, grows at 5%. And what that means is that countries that have hitched their economic wagon to China do relatively well. Those that have hitched their wagons to developed markets, US and Europe in particular, do not do well. Now we happen to have hitched our wagon to China. Now, there's several serious issues with the South African economy. We know that we've been in structural decline for some time. I mean, you just have to go and open a newspaper and you can see all the issues, Eskom, Transnet, water, etc., etc. But despite all of that, we export goods. And when the Chinese economy is ramping up, they buy the stuff that we export. And we receive stimulus and support for our economy through that. We don't take full advantage of it. We should export more. We do tend to fight with one hand tied behind our back. But nonetheless, the winds are so strong from China that despite the fact that our sail has got a lot of holes, we're still going to be driven in the right direction. So we still expect growth in the South African economy to surprise on the upside. The consensus number is around 1. We expect it to be around 2. It's not enough to solve the social ills in South Africa, but it's more than we're going to see in most developed markets over the year ahead. Now, there is a lot of talk about recession. It's somewhat secondary. The fact is there's going to be a large slowdown. Whether it lands up with a recession or not is probably moot. But if we want a ranking, at the moment, there's about a 90% chance that the UK goes into recession. It's the highest probability of all the countries that we track. About a 65 to 70% chance that the US and Europe go into recession. South Africa, at the time of putting this chart together, which was not that long ago, was at 35%. It's actually increased a bit now. It's closer to 50%. But we're still lower than most other countries. But we still need to guard against the fact that developed markets are going into recession. And when that happens, it typically is associated with greater volatility. We do need to have our hard hats on. There are also going to be opportunities. We need to be prepared for the point at which we jump back in and we increase our risk score. So we're off at the moment. We don't think it's going to be too long before we're going to find some bargains, and we will hopefully be able to take advantage of them. What about inflation? Inflation has been the issue. It's the reason we're looking at recession now. Inflation has been very high. Central banks have hiked. When central banks hike rates by 400 basis points, as they've done in the US, you land up with a slowdown, very simplistically. So the key question is, how long is inflation going to be a problem? Is it the next few months, in which case we should be preparing ourselves now to look for opportunities? Or is it for the next 2 years, in which case we should be sitting back and trying to find real assets to hold for the next little while? The good news is inflation is unlikely to be an issue in 12 months' time. This chart over here shows forecasts for inflation 1 year out. That's the sort of lighter gray line. compared to inflation at the moment, that's the, sorry, not lighter grey line, lighter grey dots, compared to inflation at the moment, which is the dark blue dots up at the top. So inflation at the moment is high pretty much everywhere you look. Much higher than central bank targets, which are the lines in the middle, but is expected to come down quite rapidly over the coming 12 months. And if you look at South Africa on the far right, inflation is expected to be about middle of the band within around 12 months or so. In fact, by around September this year, we'll end up with inflation that's close to middle of the band. And at that point, we get rate cuts in South Africa, ahead of what we expect elsewhere. In developed markets, inflation in 12 months' time likely to be slightly above central bank targets, so not enough for them to really provide a lot of support there. The opportunity is emerging markets. Inflation is not going to be a problem in emerging markets in 12 months' time. They hiked earlier, they've got wider targets, it's less of a problem. The opportunity from a monetary policy perspective is in EM at the moment, not DM. The Fed doesn't see things in the way that we see it. So we think inflation is not going to be an issue. In fact, we think inflation is going to surprise on the downside over the coming 12 months. They don't see it that way. They look at the non-farm payrolls number, and Powell was speaking last week. He says those numbers are strong because the economy is strong, and this is going to take a long time to cool down, and we need a hike. So they're signaling very clearly that they don't care that the US is slowing and going into recession. They're going to hike anyway. The market is expecting 2 more 25 bip hikes by July, and then for rates to be about flat before they come down slightly next year. We're on the same sort of page. We think they're making a mistake. We think they shouldn't be hiking. But it's not our job to say what they should or shouldn't be doing. It's our job to think what they are going to do. And we think they're going to hike. And that puts the US into recession and further pressure on the US economy. There is going to be a bit of good news, believe it or not, coming up, but we just need to get through 1 or 2 more slides of concern. In amongst all of this concern around recession and the possibility of a slowdown, you would like a margin of safety in global equities and US equities in particular. Unfortunately, at the moment, you do not have that. This is earnings for the US market relative to trend. It's a very simplistic chart. It's based over the last decade. We could extend that trend back a century if you wanted, and you would see a fairly regular deviation around trend. At the moment, earnings are at a cyclical high, unequivocally. Margins are at a record high. It's extremely unlikely we are going to see a burst in earnings off this level. It's unlikely. The economy is slowing. Margins are going to contract. If anything, that dark line is heading back towards a trend quite rapidly. And if history is anything to go by, when you go into a recession, you'll end up shooting below the line, not just getting to it. So earnings are not giving us much comfort. If earnings are well above trend, you would want PEs to be low by normal standards, because then at least as earnings come down, there's scope for perhaps a re-rating. You can still eke out some return from the market. This is PEs relative to the 10-year median. Again, we could do this over any time period you want. You're going to get a similar result. The US market, the PE at 18 is roughly in line with the historic average. There's no margin of safety from a multiple perspective. You're going into recession, the Fed is hiking, earnings at a cyclical high, and the PE is not cheap. We're underweight the US. You look elsewhere across the world, and there is opportunity. Europe, the PE is 22% below normal. The UK, it's 30% below normal. You need to be a bit careful there. A lot of it's energy. In South Africa, it's 40% below normal. If we've got a risk bucket to allocate, we're going to be allocating it more, very simplistically, towards the places that are going to reward us for taking risk. And at the moment, we find that broadly in emerging markets, and specifically in South Africa. We're pessimistic. Barry's got more on that. Another bit of good news for South Africa, this is the inflation-adjusted trade-weighted dollar. So it's a dollar versus the renminbi, the euro, the rand, the pound, weighted by the amount of trade the US does with each of them, and then you strip out inflation differences. Purchasing power parity would have you believe that this series is going to be flat over time, or at least mean reverting. It's still very much at the top end of the range. The dollar is very strong. It's hard to see how it gets much stronger. It's close to the strongest that it's been in 50 years. There's only 2 occasions from 1974 through to now where it's been stronger than it currently is. And as the US slows relative to emerging markets and inflation surprises on the downside, we expect that the dollar will continue to weaken. It's only just started. And dollar weakness is extremely helpful for emerging markets, and it's extremely helpful for commodities. So in this maelstrom, we need to be cognizant of the fact that there will be certain spaces, certain sectors and asset classes that will likely be sheltered, partly as a result of this. In addition to that, there's another massive opportunity globally. A number of countries across the globe have made commitments to get to net zero carbon emissions by 2040, 2050, 2060. Some of them very cleverly have pushed those commitments out, like India, 2070. Some of them have written them into law. They have to do it. And so they're imposing policies to ensure that they get there. For example, in Europe, they're looking now at banning all internal combustion engine vehicles within the next 12 years or so. You won't be able to sell a new diesel BMW in Europe if this is passed. What that means is we need the metals for the energy transition. This is an example of some of them. This is from the IEA. We've got similar work from the IMF. We've got our own resources analyst with about 25 years of experience, a PhD in chemistry. He's done all this work himself, and this is a key part of our investment process. We are going to need about 25% more copper. Sorry, it's actually a bit more than that. It's about 50% more copper if we're going to go through the net zero approach. If we go according to the current policies, as stated, then we need about another 30% of copper by 2040. It takes 15 years to get a copper mine up and going. There'd be no new discoveries in the last 5 years. Nickel, you can see on that chart, we need probably about 3 times as much nickel. Cobalt, we need 5 times as much cobalt. Lithium, we need 8 times as much lithium if we're going to get to net zero. Where's it going to come from? There's a massive squeeze about to occur because miners are not investing. This is total mining capex relative to depreciation. That's what happened the last cycle. It got to 3 times as much. The miners were digging deeper holes in the ground. They were expanding. They've learned from their mistakes. They're not doing it now. So there's all this demand that's coming for these commodities, and the miners say, well, we can't get access to capital on cheap terms anymore because nobody wants to invest in us because we're dirty. We try to open up a mine in a country, and people say, no, you can't do that because you're going to pollute. So they're not investing anymore. There's no increase in supply coming through, or the increase is fairly marginal, but we know demand's going to go through the roof. It's hard to see how that resolves unless there is a massive increase in price, which will incentivize more production. So that's a major key theme for us. As I say, broadly, we're pessimistic. We expect a recession, but we are actively seeking opportunity to be able to still generate a reasonable return through what we think is going to be a very difficult period. And on that note, I'm going to hand over to Barry.
Thanks. Hold on, Chris. Okay, just you can all hear me. Good morning, everyone. Thanks for coming to listen to us. I'm Barry Shamley. I manage the Investec BCI Dynamic Equity Fund as well as the BCI Global Sustainable Equity Fund. And what I'm going to try and do today is explain a little bit how we take what Chris has told us from the top down and implement it from the bottom up. So I wanted to start off by saying I recognize South Africans are very resilient, and often you would associate resilience with optimism, but unfortunately that's not the case in South Africa. I think we're extremely tough on ourselves, and I think if we had to look back over the past decade, you'd see in most cases, if you look both at the currency and at the equity markets, we haven't actually done any worse or any better than the average emerging equity market or currency. This is a basket of currencies, JP Morgan Emerging Markets Currency Index. 10 years, pretty much exactly in line. If you look at us versus MSCI EM, this is a total return index, 10 years, almost exactly in line. So while we're very hard on ourselves, I think a lot of us sometimes compare ourselves to a developed market. In our neighborhood, we're actually doing just okay. Although I probably need to contextualize that. Maybe just okay is not fair. We have derated significantly over the past number of years. We did trade at a premium to to emerging markets, more or less in line with developed markets. And you'd say from around 2017, that link started to break. Part of it, I think, was some of the strong earnings coming from the miners. So we saw those earnings, those PE ratios come down a little bit. Part of it might be Naspers coming down as well and bringing that PE ratio down. And then part of it definitely was loads of money leaving our market, going for what was considered better opportunities in developed markets, and those were very good opportunities for a period of time, but those companies became expensive, and things have changed. I think most importantly, what has changed, or what we think is going to change, is we've been through a period of very low rates for an extended period of time. We've had a very strong dollar, and that has negatively impacted emerging markets and benefited developed markets. So those trends that we think are changing, Chris has spoken now about that demand for green metals. We're in a very positive position in South Africa. A lot of these metals come from South Africa, certainly on the PGM space, manganese, nickel, and in time to come, I'll show you just now some copper as well. And it's not just us. We look at a number of external houses as well for macro research, and you'll see on the 10-year view, BCA are overweight both emerging market currencies, fixed income, and equities, more so than they are in any of the developed markets. So bringing it back to show how we implement this approach in for the other two funds that I manage. Sorry, excuse me. I'm going to talk a little bit about the Dynamic Equity Fund. This is a style agnostic fund. It's an SA equity fund. We invest across all market capitalizations, and really what we're looking there for are exciting opportunities, but one key factor for us are good management teams that understand return on capital. That's crucial for us. So while we're style agnostic, I thought I'd bucket the opportunities just to give you an idea of how we spread out. So we look at the benchmark, but we don't sort of try and be overweight any particular sectors. We really just look at the benchmark more to ensure we diversify it sufficiently. But to explain how we are positioned at the moment, you can see there we've got some of those renewable transition plays, and there are a couple more that we're looking at. You can see we've got some SA Inc. value plays, we've got some underappreciated growth plays, discounted investment holdcos, and some offshore revenue plays through capital and counties and master drilling. And master drilling, I guess, playing that exploration side where there has been a bit of underinvestment in the resources space thus far. We're not afraid of growth, but we don't like to overpay for it. We do have a slight value bias. So the exciting thing in South Africa, which I don't think many people are aware of, is we actually used to produce a lot of copper, but from the 80s, that has declined from 200 kilotons per annum to, it's probably declined close to 80%. So even though the total revenue has been increasing quite nicely, the actual production has declined quite meaningfully. What's happening now is you've got two projects on the go. There's Orion and Copper 360, which is on the verge of listing on the JSE. And using the projected production from these two companies, you can actually see that production is going to jump up quite meaningfully in coming years if they meet their production guidelines, and be a nice contributor to revenue for the fiscus as well, create some jobs in the Northern Cape, etc. So this is on the map where you see there in the Northern Cape the two projects. Orion is already listed. Still a lot of capital that will be raised by Orion in time. Copper 360 will probably be placing some shares in coming weeks or months. The difference between the two is actually 360, although it's not listed, is actually producing already and is generating cash flow, which is quite exciting for us. And I'd say where we add a lot of our alpha is we research under-researched companies. We get down on the ground, get our hands dirty. This is Campbell on the left there. The last 2 weekends, and I'm amazed he's been doing this on his weekends, he's gone up to both of those mines and checked them out. As Chris mentioned, Campbell has an extensive background in commodities and chemistry, and is extremely well placed to help us identify opportunities in that energy transition space. Bringing it back to the Investec BCI Global Sustainable Equity Fund, this fund really looks at global equities, but what it does, in addition to our existing framework where we look at companies that have a very strong cash flow return on invested capital, high-quality companies, we also use a framework for sustainability based on the United Nations Sustainable Development Goals. And ultimately, what we're trying to do is find great companies that also do things the right way, basically, very sort of in a short way. So what we do is we've got a third-party provider that measures the companies for us and tells us on a basis of -10 to +10, and we look for only companies with a positive score, whether they're contributing positively to the Sustainable Development Goals, and we don't buy anything that has a negative rating. As it stands right now, the total portfolio score is 4.7. If you had to compare it to the benchmark MSCI World, it's 1.2, the MSCI World, but you'll see that over half of the companies in the MSCI World have a negative score. How this methodology works is it assesses each of the 17 Sustainable Development Goals, and it looks at both your revenue, your operations, and any controversies around the mine, or around the company, to assess whether they are making a positive or negative contribution. And it nets them off. So a company may have some good, it may have some bad, but if the good is more than the bad, you'll end up with a positive score. I think importantly, if you look at all these names, you'll be familiar with a lot of them. So in terms of weightings, you can see by the actual weight in the portfolio, a lot of those names you'll be familiar with. In terms of the top contributors by sustainable development impact, you'll see companies, a lot of the medical companies, but companies that like Quinniclick, DSM, make quite a meaningful contribution to sustainability in some of the products that they produce. An interesting one, methane is obviously a big problem from cows, and basically they have a supplement for cows that reduces their burps and farts, basically, the methane in their burps and farts. Importantly, what we need to talk about is that there's no energy transition within the miners, and this is how the Global Sustainable Equity Fund is different. So a lot of our peers internationally don't have any of the miners, and it just doesn't make sense. I mean, you can't do this without the miners. So what we've done is Campbell's been collecting data for years. We measure all of our ESG metrics ourselves. We obviously use third-party research as well, but you'll see we've got emission data, water usage, TRIF rate, safety, community spend as a percentage of EBITDA. When we looked at Anglo-American, as you can see there, the Scope 1 and 2 emissions. So Scope 1 is what you produce yourself. Scope 2 is what you buy, essentially, from Eskom. Scope 3 is like downstream, what your producers use, or who uses your commodity, what they do. You can see Anglo's best scoring on Scope 1 and 2, or lowest scoring. And that's because a lot of their green initiatives, you've seen their hydrogen trucks, they've been very much on the forefront of sustainability in the sector. And then in terms of their Scope 3, they're strongly rated as well. And then lastly, like I said, we do look at all the other third-party ESG and sustainability scores as well. Anglo's as top scoring of the diversified miners. It's got the best CDP score, and most importantly for us, from an ISS SDG impact score, which is the one we use to assess sustainability, it's the only one that actually has a net positive score. So that is a core holding for us in our Global Sustainable Equity Fund. So sorry I rushed through that. We try to fit in a lot of information. Thank you for your time. I hope I'm leaving you a bit more optimistic about South Africa's outlook, and you understand our process a bit better from a top-down, bottom-up perspective. Thank you.
Chris and Barry, thank you very much for that. I just want to check quickly, we're a bit out of time. Are you going to stick around for tea time, or are you leaving straight away?
Unfortunately, we do have another pressing commitment back in Sandton, so we need to fly.
No problem.
But should there be any questions, we're happy to deal with them. And I need to apologize, I stole some of Barry's time. It was me, not him. So that's why he was a bit rushed.
No problem.
Yeah.
The BCI team also knows how to get hold of you guys. So if there's any other questions, anything on the funds you want to get hold of the Investec team, please let us know and we'll get you through to them. James, thank you very much for your time of coming through. Really appreciate it.
Thank you very much.
Great presentations.
Yeah,
thank you.
Thank you.
Right, next up is our fixed income managers. I see Philip's been sitting next to me, ready in the blocks, ready to go. Two very passionate fund managers on fixed income, Conrad Wood from Alawana Capital and Philip Bradford from Portfolio Metrics. There's been a lot of talk about bonds, how bond yields are very attractive. We've been saying for the past 12 months. But it's been very volatile. And a lot of you ask, but yeah, okay, how do you enter that sector? Do you add more bonds to portfolios? But the question is always, do you go for more floating rate, fixed rate notes? And what yields do you lock in when? So my answer very often to a lot of clients is, but give it to the professionals, let them do it, because they do it exceptionally well. James, thank you very much for your time this morning. I do appreciate it. I'm not going to take any further time. And the clock starts now. Thank you.
Thank you, Eugene. Thank you to BCI for the opportunity, and thank you to our clients and prospective clients, hopefully. Thank you for making the time to come and listen to us. So talking all things fixed income, and particularly in the context of flexible income portfolios and what we can expect from those in the coming year. So if we get started, what is very pleasing about leaving 2022 is that it was it was horrible. It was one of the worst years for global fixed income in the last 5 decades. And you may ask, how does that happen when all we're doing is moving from low yields to still relatively low yields? Well, it's the magnitude of the move. So on the left-hand side of that chart there, you can see probably the most single important driving factor of what has caused a lot of the dislocation, in our opinion, is the Fed's balance sheet. And you look at that as a proxy for money and liquidity creation. And the Fed has taken their balance sheet from $1 trillion to $9 trillion in the space of a decade. They own $9 trillion of their own bonds. The Fed is the largest holder of US Treasuries in the world. They've bought 1 in every 2 bonds issued by their own government in the last decade. So if that's not a Ponzi scheme waiting to unwind, I don't know what is. So $9 trillion of liquidity into markets. It took a while, but on the right you can see that eventually it manifested itself in inflation. So the gray line moving up, US inflation all the way to 9%, taking US bond yields all the way from 0 to just over or just under 4%, creating some of the biggest total return losses that we've had, as I've said, for a very, very long time. The local fixed income market was never going to be spared under that scenario. And these 2 panels show you the move up in nominal bond yields on the left and inflation-linked bond yields on the right. And those are up in the region of 60, 70, 80 basis points. I guess if we want to look for the positive angle is that we were actually quite resilient given what happened to global fixed income. It could have been a lot worse. But those types of yield moves are going to subtract quite dramatically from your capital value of your bonds. And a view that I heard at the beginning of 2022 a lot is, oh, but bond yields are so high. They give you a buffer, they give you protection, they're a sitter. You have to own them. Well, they underperformed cash in 2022 despite their high yields. And the moral of the story is when inflation's rising and central banks are hiking, high yields could just get higher. It's as simple as that. So we have quite pedestrian total returns from domestic fixed income instruments. In fact, both bonds and inflation-linked bonds underperformed cash for calendar year 2022. The only asset you really wanted to own in flexible income funds was US dollars, foreign currency. That was a great performer. Listed property lagging. Over 3 years, it looks a little bit better, where you've got substantial outperformance of cash from bonds and ILBs. But still, 2022, not a great year for domestic fixed income. And so we're left with this picture for multi-asset income funds. And what you read into this is that in 2020 and 2021, you can see the orange dots are the top quartile money market fund managers. Okay, and I would suggest that that's a base case of what you want to achieve with your fixed income investments. Money market type returns, you should get those. Those were outperformed by most multi-asset income managers in 20 and 21. You can see only the bottom quartile really underperformed your top quartile money market manager in those 2 years. If you have a look at 2022, with fixed income asset classes being under pressure, and these are the asset classes that are used in multi-asset income portfolio construction, you can see that the top quartile money market manager was in the middle of the multi-asset income sort of sector, with only your second quartile and your top performing managers in the multi-asset income space beating cash. Again, not a disastrous outcome given what happened globally, but still a year of pressure in multi-asset income portfolios. So that's out the way, thankfully. Let's look forward to 2023. The first thing as an income fund portfolio manager that I want to look at and not ignore is money market rates have gone up quite dramatically. You can see in the green and the red lines there, particularly the green line is a 12-month bank NCD. The most vanilla fixed income investment you can make is at 8.5%. I don't want to ignore that level of yield for that low level of risk when constructing an income portfolio. So that's my point of departure. I now have 8.5% yield from normal bank NCDs that I can start to construct a flexible income portfolio with. However, on top of that, And if we look at what we call our fixed income investment clock, the left-hand quadrants in red are kind of the no-go zones for fixed income. When you're moving through that area, be careful, be defensive, look for quality, bring duration down, bring credit down, bring listed property down, have foreign currency, all the obvious things that we don't do, but that this helps us to do, is when inflation is rising and rates are rising. We are now tilting to the top right-hand quadrant of the clock. We're past the inflation peak, and we're at or near the top of the monetary policy tightening cycle. So with a bit of uncertainty and forecast risk, we're moving into the top right-hand quadrant, and you can see there, if you look at a stylized portfolio, what portfolio generally does well in that stage of the market. You can see this wants you to start adding duration to portfolios, adding bonds, underweighting cash, bringing things like listed property, your more high beta fixed income asset classes in, downweighting your defensives, ILBs, building up credit exposures. The start of a more aggressive and a more risk-taking approach in fixed income is what we see the current phase of the cycle suggesting that we do. Now, that opportunity set is relatively consensus, I think. And the reason it's consensus, the speakers before highlighted these factors, I'm highlighting them under the opportunities there. We do have slowing global growth, but it's unlikely to end in really hard recession and deep recession. We do have inflation coming down. We have monetary tightening cycles coming to an end around the world. We have the China reopening bounce. And importantly, we have weak dollar, which is good for EM and commodity prices. And I get back to my tongue-in-cheek comment at the beginning. Yields are high, okay? They are high relative to cash, relative to inflation, and so there is an element of protection in them. So that's the kind of opportunistic and bullish case for fixed income, as well as the cycle confirming that it's time to sort of push the boat out a bit. But it's not without risks, guys, and this makes 2023 really, really difficult. And they're not immaterial risks. They are very, very real risks, which I would guess are going to manifest themselves more than just on the fringes during the year. And we start with the global economy. It's completely desynchronized. You have the US slowing down in growth and slowing down in inflation. You have Europe having slowing growth but rising inflation. You have China having rising growth and rising inflation. And you have Japan having rising inflation and stagnant growth. Normally, DM is quite synchronized, behaves as one unit, and you can kind of get the cycle from there. DM is completely out of kilter and out of sync, which makes guessing what policymakers are going to do, fairly hard. The biggest single most important factor for fixed income is that second risk there. Is inflation really going to come down like everyone says it's going to come down? I would argue that I certainly don't know anyone who has the moral high ground on inflation forecasting after the debacle of last year. No one came within a country mile of getting inflation right from what I could see. So anyone who stands up and says inflation is going to 2% by the... There's forecast risk. We are in, as I said in the beginning, the unwind of the great normalization. We don't know what's going to happen with inflation, and it's very difficult to pin it down. What if inflation doesn't come down as much as we thought? What if it stays sustainably higher? Is a massive risk for fixed income investing. Geopolitics, very, very elevated, and there are any number of axes that we should be worried about as pretty much a new Cold War between the US and China in tech space rather than rockets and gun space is developing. And that brings massive uncertainty for the outlook for the globe. And then you add a long list of South African factors into the mix. We have quite an acute SOE funding crisis. We have energy shortage that is debilitating. We have elevated political risk, and it's all culminating in fiscal vulnerability that has seen us build up a debt burden that we can't really afford for our level of economic growth. You look at those risks on the right-hand side. I can see the bullish case. I can see the constructive case for fixed income. In fact, my base case is for flexible income funds to do quite well this year, but I think it's going to be quite uncertain and a little bit bumpy. So at the risk of going against all the advice of not to forecast and not to predict, I've put up a nice wide band of expected bond returns for the year. Call the orange one my central tendency of double-digit returns from bonds. for 2023 because of those opportunities that I've highlighted and because of the move in the cycle. If I put a standard deviation band around that and I go, well, what's likely to be the low case and what's likely to be the upside case, you can see that we're talking somewhere between 8 and 14. Now, 8 would be a money market type return or slightly below, which I don't think is bad. And then there is quite a bit of blue sky if the planets align on that cyclical outlook. Of course, guys, there's a risk scenario where some of these things that I've highlighted go completely pear-shaped in the year and we have bonds underperform cash substantially again. That's always there, and it's going to be just up to active managers to try and dodge that bullet if it does come along during the year. So the volatility I'm referring to, which is making life somewhat difficult in a flexible income fund, but also creating opportunity, is we don't see protracted cycles. I'm used to managing money where there was a predictable cycle. You got into that quadrant of the clock and you put your duration positions on and your exposure and you rode it for 12 months and consecutive months delivered and it was quite predictable. The Albi is like a seesaw. It goes 1 month positive, 1 month negative, 1 month positive, 1 month negative. Those are the monthly returns from the All Bond Index. And it's just very, very difficult to manage. There's no cyclical trend in bond returns. They're up one day and rallying, and then they're down the other day and the next day and selling off. So, to look through that and to try to take advantage of these tactical opportunities, we think is quite important. Now, that's the beauty of these, if you find a well-managed flexible income fund. So on the right-hand panel is the Aluwani BCI Flexible Income Fund. And you can see around the red line, which is the fund's net return over time, you can see around that the asset classes are going mull. Okay, the volatility is there. Bonds are flying sometimes, and then they're below the fund, and they're above the fund. ILBs went on an absolute tear in this latest inflation spike. They're coming back somewhat. CPI was plodding along, and now it's going ballistic. And one of the lines there, I can't see the color, is cash. But the beauty of these flexible income funds over time, if managed properly, is at much lower volatility than what these asset classes are jumping around at. You get your fund creeping up consistently, compounding, and over longer periods of time, what you end up with in certainly the top quartile funds in the sector is you outperform all these fixed income asset classes, you outperform inflation and cash. So that's the game here. So it's almost take the burden off asset allocators and clients, put it all in a one-stop shop, and let a good manager engineer an outcome that is going to be above the fixed income asset classes. So that's what we're going to try and continue doing in 2023. I think my best guess for flexible income funds in 23 is that they do close to double-digit returns, if not double-digit returns, with those bond returns like that, but with risk and volatility. Thanks very much.
Great. Oops. Great. Thanks, Conrad, and thanks, Eugene and Robert and team for getting us here today. I'm Philip Bradford. I run the Portfolio Metrics BCI Dynamic Income Fund. I do that along with my team, Liam and Ricardo. We've been doing this for quite a long time as well. Our job really here, it was a fixed income. People get a bit excited about bonds and they're never quite sure exactly what they are. Our job is really to shop around and try and find the best interest rates that are available at any given point in time. The challenge with that is it changes a lot, as we've seen over the last year or so. So we dynamically manage the strategy, and we've done nicely over time, but we'll come back to that a little bit later. So I was flying last year, and I was coming to land into PE, and the plane couldn't land, and there was some turbulence coming in. And I looked around the plane, and it just reminded me of investors. There were some people that had never flown before, it looked like, and they thought they were going to die. And there were other people who just don't like flying, and they don't like the volatility, and they also thought maybe it was going to end. And people who are used to flying understand that turbulence comes. The real question we've got to ask as investors is, well, is it turbulence, or is it actually, are you going to die? And this is what turbulence is like, and that's kind of what it feels like. And we understand that investors are stressed by this. So it's very important to understand when we're investing, we're looking for investments essentially there where there might be some volatility, we added a bit of risk, but we need to make sure that it's just turbulence at the end of the day. Bonds are a misunderstood asset class. Over time, bonds are actually like a fruit tree. Equities are like a tree that you want to grow for timber, you want it to grow to the sky. End of the day, bonds give you income. The average income of bonds over sort of 22 odd years here has been 9.6%, and the average return of bonds has been 9.5%. Actually, it's actually had marginal capital losses on average over time. But at the end of the day, your return is going to be largely the income. But we have big capital drawdowns. Last year was a tough year. You can see there we had the bonds actually were down 5.5% in capital, but they finished up 4.3% in total. So your income was 9.8 and your capital was down 5.5. So plus and minus, you ended up with just over 4%. Now that's not a bad scenario. That's actually still okay. It wasn't as good as you could have done, but that was a disaster. And last year, let's be honest, was a terrible year. It wasn't as bad as Nenegate. That was the last negative year, but COVID, bonds actually fell 19%. So a lot of what we're trying to do is try and invest in bonds, but try and avoid those big capital drawdowns. And last year was actually a good example of that. Cash was up 5. Income funds in general, I don't know if this, where's it gone? Income funds were up around, where did I go? There. Income funds were up about 5.5% in the category. The bond market was up 4%, as I mentioned. Most other asset classes were down despite the real strong bounce back at the end of the year, but we managed to be up just under 8%. So really the trick here is to be able to pivot, the new word that everyone discovered last year, pivot. We needed to be able to adapt and change. When interest rates get higher, you want to invest in them. When they're not higher, you want to stay away from them. So really, how do we go about doing that? I'll touch on that in a moment. So why have we done well in this volatile market? Well, this time last year, actually the budget speech last year was interest rates, the bond yield, 10-year bond yield had dropped to 9%. The rand was around 14, and the next day Putin invaded the Ukraine, actually. I was sitting there thinking, wow, we're never going to see interest rates back at 11% again. 11.5%, it's not going to happen. And guess what happened? Putin invaded the Ukraine. All of a sudden, everyone woke up to the fact that inflation was going to be there. And what we did is we actually doubled the bond exposure at the time. Because guess what? We were able to buy interest rates at over 11%, 11.5%. It made sense that 11% is a fantastic return. We then had to reduce that exposure. We then had to increase it again when the US woke up to the fact that they're going to have to raise interest rates. We then reduced exposure again as the bonds rallied. We increased the exposure again when Liz Truss pulled their own Nenegate in the UK. And then we increased the exposure again during Phala Phala. And what was quite funny for me with Phala Phala was the last time we actually got to this kind of exposure across our portfolio in bonds was actually during the last ANC elective conference. And I was watching that so closely going into the end of last year because I knew there was going to be trouble. I knew that there was a wage negotiation coming on and something was going to happen. You didn't know it was going to be Phala Phala, but the chances of someone causing trouble was going to give us a buying opportunity. So we were sitting back, waiting and looking for it. And then, yeah, you got to go back to even just after Nenegate when we were last at this sort of level of bonds holding across the portfolio. And what does this mean? Well, we've added higher yielding instruments and interest rates have gone up and the yield of the fund's gone from below 8% to actually 11% is the gross yield of the fund today. So that is the average interest rate that we're holding across the portfolio. And that's a fantastic opportunity. Whether you're 18 or 80, that sort of return is good. It's the kind of return we are hoping to get out of equities and balanced funds over time. So it's really a great opportunity to add some of those higher interest rate yielding instruments to the portfolio. You don't need to add too much because the interest rates are high enough. And investments are a bit like rubber bands to me. And bonds are a tighter rubber band. Equities are a much looser rubber band. What you'll notice over time is that equities can fall, they can stay down, property the same, and it can stay down for a very long time. US equities, the first 10 years of this millennium were zero. Average return of zero for the first 10 years of this millennium. People forget that. The next 10 years seemed a lot better. Bonds are a much tighter rubber band, so they don't stretch out as far, and they recover much quicker. The power of that means that when we do add fixed rate bonds to the portfolio, they might be a bit more volatile than cash and some of the other income instruments, but we're very confident that they're going to come back relatively quickly as well. You might have 2, 3, 4 months sometimes as a real disaster, but we've got a very high degree of confidence, particularly over 12 months. And if you're drawing income out of a portfolio, you don't want 12-month capital drawdowns. That's a disaster. You're starting to draw out of capital then. So what we look at, if you look at the asset classes over time, is this thing working? No, where's it gone again? So what you'll see here is, on the right, we've got global equities, SA property. And this is your 6-month range of returns. And you'll see it's not unusual for equities to be down 20% over 6 months. It happens. This is over the many years we've seen it happen again and again. You can have very good returns. What you'll notice out of bonds is a real disaster 6 months is something like 6 or 7% down. And then you'll see in terms of our strategy that we've been managing way back to 2015 now with the combined funds, the worst 6-month period we've ever had has been about 0. And that's in the middle of COVID when bonds fell 19%. So what that gives us is a high degree of confidence that the type of instruments that we're holding, the type of strategy, and how we're managing it, we're unlikely to have a negative return over anything longer than 6 months. And that's in the worst possible scenario. The average return tends to be between 4 to 5% over a 6-month period. That's the normal sort of range. That's reasonably what we would expect. And here it shows you our rolling 12-month returns over time. And this is, again, we focus a lot on what's the worst case scenario. If you'd invested just before Nenegate, just before Jacob Zuma woke up and fired Nene, and bonds crashed, absolutely crashed, 12 months later you were up nearly 9%, just over 8%. If you invested just before COVID, and the bond crash during COVID was 3 times worse than the financial crisis, 12 months later you would have been up just around 8%. And this last year, which was, think of how many nightmares happened this last year. Normally we have 1 or 2 sell-offs in bonds a year driven by global events. Last year we must have had 5 or 6, just big, it was just turbulence the whole year. And if we're still able to generate close to 8%, that for us is a bad year, but still a good year. And that's what we want as investors. We want the bad scenarios to still be actually a relatively good scenario. And that gives us much more confidence to invest into an asset class. What we don't want is asset classes that have big drawdowns and we just don't know what they're going to do. So over time, this has worked very well for us. By dynamically moving around, we've managed to outperform bonds and cash. So we're probably the manager in the space that holds the most bonds, but actually we've still been able to outperform the bonds and the income funds in the category, and you can see that quite consistently. But most importantly, with much less volatility. And volatility is that elastic band. The tighter that band is, the less drawdowns we have, the faster it tends to come back. So you tend to win by being less volatile rather than by being more risky over time. And then you can see over the last year as well, very confidently and ahead of that. And what this has shown, and this is over the current fund's track record, we tend to get about 70% of the upside of the bonds, but only about 20% of the downside. And that's very, very powerful. Because that means when markets do fall, we only fall a little bit, and then we've got extra cash to invest into them. So we're able to catch the rubber band as it comes back again on the other side. And over time, that's about 20% over the last 2 years. You can see here, just over the last 2 years now to the end of January, around a 20% return. That's comparing to all the other peers in the market there. And then over the longer term track record, exactly the same as well. So the difference between our strategy at the top and the bottom funds is 70% over 7.5 years and a bit now. And that's an enormous difference. And the real thing is look for the opportunities. And I'll show you what I mean now. If we go back to 2001 and 2008, 2002, the repo rate was 13%. If I offered you 10%, you would have gone, I can get that in cash. That's easy. Income funds were giving you about 1% more. If you go back to 2008, repo rate was 12%. It made absolutely 100% sense to go buy bank floating rate bonds and earn 13%. It was great. What a pleasure. Now what's happened, though, is a lot has changed. The other thing you want to notice here, by the way, is that who's been asked by their clients, can't I just put my money in a fixed deposit at the moment? Because guess what happens? When interest rates go up, they go up today. Your fixed deposits and that are held in money market funds mature in 3 months, 6 months, 12 months' time. You've got to wait for them to mature. So when interest rates go up, income funds and money market funds tend to underperform cash. And in the falling market, they tend to outperform because you've fixed your rates. So what also happened, though, if you go back to 2008, cash was giving you 12, 13%. But bond yields, if you fixed your money away for 10 or 20 years, you were only getting 7 or 8%. Now, why would you do that? So it made sense. Guess what? We'll all go invest in income instruments. What's happened now, though, is cash rates are around 7% and bond yields are between 11 and 12%. Now it makes sense to fix your rates. And this last 15 years, we've had this fantastic time of not having to invest in fixed rate bonds at all, but the opportunity now is the other way around. We've actually got to say, hang on, I want to try and fix my money. And what we do is we obviously are constantly changing. Sometimes it's the 20-year bond that's looking attractive, your 20-year fixed deposit. Sometimes it's the 18-year bond. Sometimes you don't want to hold any of them and you want to get out again. You don't want to go lock your money in a 10-year fixed deposit for 10 years and just hope that nothing changes. We actually need to dynamically make those changes across the portfolios. And just to hammer home that point here, if you go back to 2008, if you look on the left here, interest rates, if you fixed your money in a 20-year bond, a 20-year fixed deposit, you got 4% less than cash. Then after 2008, you started getting 1 to 2%, what we would call a normal risk premium. And now what you've got, and if you see post-COVID, at one stage we were getting 9% above cash out of fixed rate bonds. And now what we've got is this very wide gap. So we're still getting 4, 5, 6% above cash in a lot of the instruments we're holding. That is, I grew up in the bond market in the late 90s, early 2000s. That wasn't normal. This is an opportunity that wasn't around 10, 15 years ago, and it's a low-risk opportunity. Here you can see our yields compared to other countries around the world. We stick out head and shoulders above from an attractiveness perspective compared to other countries. Compared to the developed markets on the left and even emerging markets like Turkey, Russia, Brazil, etc., our yields from our 20-year rates down to our cash rates has got the widest gap. That's very attractive to foreigners, but they're worried about us. They're worried about the same reasons that we probably might be grey listed, or the same reasons we get downgraded to sub-investment grade. Those are the things they worry about. So we're attractive, and they want to hold a bit of us, but they don't want to hold too much because they're worried about the governance in South Africa. So how do you know what you're going to do from bonds? What this chart actually shows, if you invested in, on the bottom line, is the yield that you invested into the All Bond Index, and the line up the left, the y-axis, shows you what your average return would have been over the next 2 years. What you'll notice is that if you buy bonds on a low yield, down to the left, bottom left, you tend to get a lowish return. If you buy them on a high yield, you tend to get a higher return. Guess what? It's like buying a fixed deposit. Now, interestingly, we're up on the top right here at the moment. You'll notice there's not a lot of dots there. We've never really been in this sort of area before. Now, what does that tell you? It tells you that if you've typically bought bonds between 11 and 12% yields, your average return out of those bonds, that part of the portfolio, has tended to be about 15%. I don't want to get everyone too excited. Conrad's already raised some of the risks that are out there, because there always are risks. There always are global things that move our bonds around and move the whole portfolio. But we've looked to add a bit of that. It's a bit like adding a bit of Tabasco to a meal. You want to add it for flavor, not too much. And that's what's great about yields at this level at the moment, is you don't have to be too aggressive. You don't have to put too much into the portfolio. And really what that part of the portfolio now makes up 40% of the portfolio. And that allows the overall average interest rate, the average yield of the portfolio, to be, as I said, actually today, just about 11. So end of the month was 10.9%. Now, with an income fund, your best indication of what your forward return is going to be is the yield. The current yield. If nothing changes, if interest rates don't change and bond yields stay the same, that's the fruit from the tree. That's going to be the cash flow. The capital might move around, but at the end of the day, that is your best indication. And it's the highest we've got the yield of the portfolio now for many years. As interest rates have gone up, this same yield was 4% lower 2 years ago. So we've been able to get the yield, it's like the speed of the portfolio, up to a nice level, and we've got now only about 40% of the portfolio in fixed rate bonds. The other 60% actually sits in variable rate bonds, which benefit from interest rates going up. And all importantly as well, is we do it at a much lower volatility than the All Bond Index. We've increased our exposure much higher than it's been for many years, but still much lower yield. So we've got a higher yield than the All Bond Index, but with much, much, much lower volatility. And that's a very powerful situation to be in because it gives us far more confidence of what our forward returns are going to be over the next 12 months. So at the end of it, really, last year was a bad year for bonds, but still a good year for our investors. And that's the scenario we want to be in. We want the bad years to still be okay and still be good enough for investors and still beating cash and inflation. Bonds are a much tighter rubber band than other asset classes, so you've got much more confidence they're going to come back quite quickly, much more than equities and other asset classes where you just really don't know what's going to happen over 12 months. Our bonds are cheap and attractive, but there's risks out there. There's global risks, there's local risks, there's load shedding, there's all sorts of other things. We want to add some, but we don't need to be too aggressive because the yields are high enough. And this dynamic approach is important. Some of these slides don't change. Bonds are cheap, but watch out. These are the kinds of things that we need to manage that risk, and we don't have to be too aggressive. The yields are high enough for you to take too much risk. So really, at the end of the day, there's an attractive story here, but you need to, as the name of the fund, dynamically manage that exposure. Thanks very much.
Philip and Conrad, thank you very much for that. There's some time for questions. Any of the audience have a question for either Conrad or Philip? You've obviously done a very good job in explaining exactly how the funds work. Thank you, gents. We'll chat to you soon.
Got some time back.
We got some time back. Right. Next up, Anil, I see you at the back. You can come to the front. Global property. Much talk about global property as a good diversifier on global equity. We've seen some couple of tough months, tough year. But the question is always, where are those opportunities in global property going forward? And here to share with us from Ses Fikile, the managers that eat, drink, and sleep, and everything property. It's about property, isn't it? And the specialists you have arrived. Anil, thank you very much for joining us on stage today and taking us through the Ses Fikile BCI Global Property Fund. Thanks.
Can everybody hear me? Yeah, there we go. Okay, awesome. Thanks, Eugene. Like he said, I'm Anil Ramji. I'm from Ses Fikile Capital, and I'll be taking you through our global property offering. So just a quick update on our company. We are founded in 2010. We are singularly focused. All we do is listed property. We have two strategies, a local and a global fund. We have about 17 billion rand under management, and we have around 62 years of combined experience. Just on the team, we think we're one of the more experienced teams in our sectors. The three gentlemen on top there, Evan, Mohammed, and Kundai, are the founders of the business. Together with Naeem, myself, and Malebo, make up the investment team. And then Tenswalo heads up operations, and Nalika heads up our business development. Okay, so why global REITs? So global REITs offers you a efficient, low-cost, liquid way to access global developed market real estate. And I focus on the word liquid because if anybody in the audience now is invested in either the US unlisted REITs run by BlackRock, or Blackstone, Starwood, or KKR, or the UK direct property funds run by BlackRock or M&G, you would know that you can't get your money out right now. Those funds have been or restricted withdrawals at the end of last year, and are actually still currently gated. However, our sector, the global listed sector, is a $1.5 trillion listed sector. We could potentially liquidate our entire fund in less than 5 days. But more importantly, there's a wide range of choice and specialization. So most of the REITs are located in the US there. You can say 66% of the benchmark is in the US, followed by Europe and Japan. But you still have access to the UK, Canada, Singapore, Hong Kong, and Australia. And again, like I said, it's all about choice and specialization. So I'll give you a little bit of a history here. About 20 years ago, the global space was very similar to the local space. We are about, I would say 90% of the market cap was focused in the core sectors of retail, industrial, and office. Fast forward to today, more than 50% of the market cap in the global space is in specialized sectors like data centers, single-family residential, senior housing, to name a few. In addition to that, you can invest in a certain sector in a certain region. So if you wanted apartments in Berlin or offices in Manhattan, you can find a REIT that focuses on that property type in that location. And that gives you that high degree of specialization. Our fund, the Sesfikile BCI Global Property Fund, has about 1.2 billion rand under management, but we are in the process of setting up our USD-dominated UCITS fund, domiciled in Ireland, should be up and running by the end of first quarter this year. So we run our fund using what we call the concentrated thematic approach to portfolio construction. So concentrated in that our fund holds anywhere between 30 and 60 stocks, compared to the benchmark that has more than 350 opportunities, and thematic in that we research, we identify, we investigate key themes that are happening in the world, and we match those themes to current property fundamentals with the ultimate objective to expose our portfolio towards sectors or stocks that would benefit from those structural trends or themes, and to be underweight stocks or sectors that would be disrupted by those themes. So just to take you through some of the themes in our portfolio at this point in time, starting off with industrial. So the core drivers of demand in industrial remain intact. So these are e-commerce growth, onshoring, supply chain modernization. However, for the first time in a very, very long time, if you look at the graph on the top left there, the gray bars in the little box are going to be bigger than the red bars over the next 5 years, which means that supply will be more than demand over the next 5 years. However, in the US, if you look at the blue line there, we are starting this new cycle at a record low vacancy rate of 3.4%. If every single square meter of space that is currently being developed in the US on a speculative basis goes vacant, the vacancy rate only goes to 6.5%, which is still below our magic number of 7%, which means that the power still lies in the hands of the landlord, and we'll still see rental growth. However, what we've done in our portfolio is we've focused our portfolio towards last mile logistics in high barrier to entry markets. And I'll give you an example of that is a core stock in our portfolio called Rexford Industrial, which is a Southern California focused last mile stock. And as you can see from the graph on the right there, they have 0% supply risk in their portfolio, and therefore remains one of our core holdings. So manufactured homes, not many people know about this sector. What is a manufactured home? Let me start with that. So a manufactured home is basically a house that's built in a factory, sort of modular design, put on a truck, and then transported to its location. The core business of a manufactured home REIT is basically the ownership, development, and operating of that little concrete pad. That's all. There's a water tap there and electricity and the pad itself. This is what a development looks like at the start of a development. That's what it looks like at the end of the development. And one thing I have to point out is that in the US, a modern manufactured house is almost the same as a conventional single-family home. The only difference is a basement. A conventional single-family home in the US has a basement. Manufactured homes do not have a basement. Now, this sector is considered very recession resilient. So if you look at the graph on the left, what we've plotted there is same property net operating income growth, and you can see the apartment space is in the dark blue. And every time we went through a recession or economic slowdown, apartment space went into negative territory, whereas the manufactured homes, which is the green line, barely dipped into negative territory. Therefore, very recession resilient, and that's driven by fundamentals. So if you look at supply, the top right, over the last 15 years, not more than 20 of these developments have been developed and opened in the US, maybe on average only 10 a year. And that's driven by the negative sentiment or the stigma attached to these manufactured homes, given that they're affordable housing. In addition to that, demand is extremely strong, especially in recessionary periods, given that it's affordable housing. If you wanted to buy a manufactured home, it will cost you 70% less than buying a conventional home. If you wanted to rent a manufactured home, it offers you 25% more space, and you get 50% less cost per square foot. So given all these positive fundamentals, we think there's really strong pricing power in this sector, and for 2023, we expect anywhere between 6 and 7% rental growth in the manufactured home sector. Moving on to senior housing. So another interesting fact, and I mentioned the specialization, this is a subsector of the healthcare sector, which speaks again to that specialization that's available in the global space. So again, another recession-resilient space. If you look at the top left graph there, I think the blue line is the senior housing space on a same-store net operating income basis, during the GFC barely went into negative territory, whereas all other REITs actually dropped into negative territory, therefore recession resilient. And that's based on the fact that it's a necessity-based property. So demand is being driven by what we call, or what's been termed the silver tsunami in the US, where the age group of 80-year-old plus is growing at about 23% going forward over the next 5 years, compared to a historical growth of around 7%. You couple that with solid demand coupled with very low supply. So if you look at the graph in the middle, supply has actually dropped down or is 50% less than its peaks in 2018. So very good supply, very good demand, very little supply, and we expect rental growth to be anywhere between 6 and 8%, and same-store net operating income anywhere between 15 and 20% for 2023. Okay, so moving on to portfolio positioning. The graph on the left is basically our regional weights relative to the benchmark. And as you can see, we keep this at a positive, negative 200 basis points. And we do that as a risk mitigation tool. And the reason we do that is because we don't think we can call FX. We think our expertise lies in choosing stocks and sectors, and that's where we show our conviction. And as you can see on the right-hand side, we are very overweight self-storage, manufactured homes, and industrial. And the left-hand side of the right graph, we're still very cautious on the office sector and retail. So moving on to our outlook. If you've seen me present last year, you would have seen this same graph. This is an analysis that we've done where we compared global listed property relative to global equities during periods of higher interest rates or bond yields. And last year, I would have said, as bond yields increased 1.24% on average, global property would have underperformed global equities in 8 out of 8 times, the graph on the left. We've updated that data for 2022. Now I can say global property has underperformed global equities 9 out of 9 times. And the reason, and people say history doesn't repeat itself, but it definitely rhymes. It's definitely rhyming at this point in time. However, we've also analyzed the 4 to 6 month period subsequent to that increase in interest rates, where we think that during that period of time, as bond yields or interest rates stabilize, we find that global property outperforms global equities in 8 out of the 9 times. And if you believe, and Conrad mentioned it earlier, if you think that we are in a more stable interest rate environment going forward, and if you make that assumption, year to date, we are actually outperforming global equities. Okay, so leverage, very important for our sector, obviously. And I will compare leverage to just before the GFC. And as you can see currently, the graph on the left there, global REITs currently have an LTV of around 32%, and this is compared to about 51% pre-GFC. So the global REIT management teams have definitely learned their lessons during the GFC and are actually positioned for an economic slowdown. In addition to that, about 70% of the debt is hedged for about 6 years, which is, again, much better than the pre-GFC levels. Finally, given funding costs are going up, interest rates are up, weighted cost of capital is going up, we do believe cap rates should expand, which means that asset values should come down, which would put negative pressure on LTV ratios going forward. Okay, just on valuation. So the graph on the left is a NAV discount. Global property currently trading at about a 23% discount to NAV. We think cap rates could go up anywhere between 40 basis points and 200 basis points, given, depending on the sector. So the office market, we still be very cautious on it. Fundamentals are not great. Work from home is still a problem. We think cap rates could actually go up 200 basis points. But on the other hand, fundamentals in the self-storage space are fantastic. And there we think cap rates should only expand about 40 basis points. One thing I want to point out is rental growth. So in certain regions and in certain sectors. So in certain sectors that have very good pricing power, very good fundamentals, will see rental growth. Regions like Europe, which have CPI-linked leases, will see rental growth going into 2023. That would definitely offset some of that cap rate expansion, lessening the impact on the asset values. And then finally, another metric that we use is the multiples. Multiples have contracted significantly. If you look at the red line, that's US REIT multiples, which is 70% of the story. That's down significantly from its highs, close to 30, down to about 20 in the 20s. Industrial multiples are down 8 turns to about 22. Residential multiples down 8 turns to about 17. what's important to note here is that relative to equities, the sector is trading at a lower earnings multiple than it normally does. Basically saying that right now, REITs are cheaper relative to its history, relative to equities. Okay, so, we got trading at a discount to NAV, we've got cheaper multiples, and I'm going to sound like a global ad here, but there's more, This is an analysis done by JP Morgan. And as you can see on the top graph there, if you look at the blue bars, that's the earnings growth rate for, again, US REITs. Earnings growth expected in 2022 for US REITs, about 12.4%. We're currently in results season. That it should go up. That should be around 13% in our opinion. It drops down to 4.5% in 2023. However, look at the S&P 500. 2022 is 8.2% growth, dropping down to minus 8.9% growth in 2023. And the example I always give is, if you have a company and there's an economic slowdown and the company makes widgets, you're going to sell less widgets, but you have to pay your rent. And that provides, or global REITs then provide that stable earnings growth profile. In addition to that, it comes with a lower downgrade risk in terms of earnings expectations going forward compared to other sectors. And then finally, my last slide. This is our total return expectation model. Currently, global property trades at around a 4.2% USD forward dividend yield. We expect growth in 2023 of around 6%. We think that's very conservative, and the reason I say this is because payout ratios are very low. So I'll give you an example here. Simon Property Group, which is the largest mall REIT in the world, released results last week. They only grew earnings or FFO about 1.2%, but they grew their divvy 9.1%. And the reason they did that is the starting payout ratio was 58%. So there's a lot of slack that they can increase their payout ratio faster than they can actually increase earnings, giving you that higher dividend growth rate. We're using a 10-year bond yield exit of 3.4. Again, we don't believe we can forecast the 10-year 12 months from now in terms of the US. So we take a Bloomberg consensus view. Anybody else want to use their views on or their forecast on the 10-year, happy to send us your views. We'll put it into our model, and we'll give you the total return that it spits out after that. But putting our assumptions into play, we expect about 7.2% growth 7.2% total return over the next 12 months. That's excluding the 9% year-to-date number in USD. And then over the medium and the long term, anywhere between 8 and 9% total return in USD. And then final slide on my side, why Sesfikile? We are singularly focused. All we do, eat, sleep, is property. We are owner-managed, experience in depth as we go from crisis to crisis. I go grayer and grayer. Commitment to cap, that's only on the local fund. The global property market cap is a $1.5 trillion market cap. There's no cap there. And proven process. One thing we cannot guarantee is outperformance, but what we can guarantee is that the process won't change. Thank you.
Anil, thank you very much for that. Any questions for Anil on global property? Well, we've heard what's been said today. If you think that interest rates are peaking or very close to peaking, then global property, probably a very good diversifier for client portfolios. And remember that global equity managers don't really look at global properties. So if you want global property in client portfolio, good fun to look at Sesfikile BCI global property. Anil, thank you so much.
Thanks, Eugene.
We are going to break for tea now. It's a very short tea break to 10:45. Coffee, tea, drinks outside, and we'll see you back here shortly. Thank you. let's get into the meat of things. Our next session is on SA multi-asset funds, low and high equity, looking at things like asset allocation in the two different mandates, and then obviously position for opportunities going forward. Joining me on stage, already on stage, is Jonathan Meyerson from Vigio Fund Managers and Errol Shear from Sasfin Asset Management. Jonathan will speak to multi-asset high equity and Errol to multi-asset low equity. I know you miss the days of typing in questions on a virtual session, but you do have the opportunity to ask a question, so you don't have to type anymore. All right, cool. So let's get started. Both the funds, the Sasfin BCI Stable Fund and the Vigio BCI Balance Fund, are top of the category or first quartile performances. So I'm quite keen to understand and to see how exactly you guys do that. Jonathan, thank you so much. Errol, thank you for joining us on stage today. Jonathan, you can start when ready. Thanks.
Thanks, Eugene. Thanks, everyone. First, let me start by saying what a pleasure it is to be on the panel with Errol, who I've known for many years. I'll run through a few slides, basically describing first the actual, how we go about managing the money in the fund, and then we'll follow on in the current view and current positions that we hold in the fund. So the story is really one of a fund that's managed by four experienced individuals in the market. Patrice Moyal, some of you would know, he's the CIO and CEO of Vigio. He's been in the market for 25 years, and he focuses on SA equities. I'm the fixed income specialist. I've been in the market for 28 years, both on the sell side and the buy side. And really, my job here is to coordinate the multi-asset kind of effort, because I've also got some experience in more macro and high-level management of such funds. On the global equity, we've got Keris Foster, who's been in the market for 23 years. Keris is a chemical engineer, and it's always good to have an engineer in a team, particularly these days when there's so many different things you need to try and understand. And then Mike Flax, who's a property specialist. He's joined Vigio quite recently. He's been in the market for 33 years. So the team is very experienced. It's a collaborative effort, and really we bring everything that we know together in this one fund, which is the High Equity Balance Fund. In terms of the process and how we run the fund, really the structure that we use is what we call the strategic asset allocation. So we sat and we worked out more or less what over a long period of time the exposure to different asset classes should be in order to give you a return of CPI plus 5, which is pretty much the standard in the category. Ideally, we want to get that with the low volatility than the individual asset classes that you might hold to get that. So we start off, it's a real bottom-up approach. Vigio is not a macro house. We obviously have macro capabilities and we use some macro inputs, but we do what we call bottom-up valuations, and each one of the teams basically provide us a expected return for the next 12 months for the asset class. So it'd be equities, domestic and global, fixed income, myself and Pumalelo, who works with me, properties, the property team, and commodity and currency is more of the macro picture. Once we've got that expected return from the team members, from the teams, we run essentially an optimization. So essentially we say, well, if these are the returns that we expected to get from the different asset classes in the next 12 months, and we know what the volatility is, what does that mean for the portfolio? How do we put it together? So that second part is very quantitative. It's a smart model. Pumalelo is here, he's our quant. Afterwards, you can have a chat to him on exactly how it works, and it spits out a quant result. We take that quant result, which comes in basically at stage 3 in the slide, and we then do what we call a macro overlay. How realistic, given the environment we're in, to have this kind of exposure to certain asset classes, because there's a tendency sometimes of analysts and fund managers to favor their asset class. Of course, not when it comes to fixed income, but other asset classes. So that's the process that we take, and there's an iterative process. Essentially, we run the structured process of this once a month, and then we monitor it on a weekly basis, and if need be, more frequently. And then we come out with what we call the tactical asset allocation. So, in other words, how different must the fund now be positioned to the long-term way that the fund would be positioned. So, for example, if we believe that over a very long period of time, call it 5 to 10 years, you should have 45% in domestic equities in order to achieve this objective. If the environment is such that equities are going to be less likely to result in that, you will go 42, 41, 40, whatever the model kind of suggests and we decide on. So that's essentially what you'll see just now when we talk about the current exposures, the tactical asset allocation versus the strategic, is where we overweight and where we underweight. So we've used this approach in the balance fund for the last 3 years. It's an approach that we use in the multi-asset, in the unconstrained fixed income fund, which some of you would be familiar with, and that's got a longer track record. It uses the same approach, obviously different asset classes in the category. So the fund's been running for just over 3 years. It's quite a noisy slide, if you like, but the green line at the bottom is the VIX, S&P 500 implied volatility. It shows you kind of how volatile the markets have been over time. And over the last 3 and a bit years, you can see the red, the actual, has been significantly higher than the long-term average. And the fund in that environment has proven that diversification and being in different asset classes and being active in those movements in the asset classes. And I have to point that the higher the volatility, the more likely you are to be active on such an active fund. And you can see that the fund has been able to both provide the expected return, the CPI plus 5 and more, and at the same time do it with a significantly less low volatility than the individual asset classes, other than fixed income. But you would expect fixed income to have low volatility, but also the returns there over that period would have been lower. So it made sense to be in the mix and make the most of the opportunities that come from the broadest asset assets available. So what is the current outlook? I'm not sure if you've heard from other houses' view. I'll take you through some of the global kind of thinking that we have and how it affects on the margin the decisions that we make on the asset class exposures. So essentially, maybe I should start off by just pointing out that we are in the camp that we are likely to get a US recession. It's going to be a mild growth recession. So in other words, economic growth will be slower than on average. I'm not going to go into too many technicalities around that. But it's not going to be a repeat of 2007 or 2008 or 2020. This is going to be a more, if you want to call it such a thing, a textbook recession. Okay? It's not one that's driven by financial market meltdowns and the like. And the point is that inflation is moderating, but remains high. And you can see, in fact, South Africa's inflation came out today, 6.9. Surprising the US a bit higher than was expected. Our base case for both global and domestic inflation is that it will, and it is already rolling over, but I think the market's getting a bit overexcited about how quickly it gets to kind of the target inflation that central banks have. So it's rolling over, it remains high, and policy rates, if you compare them to inflation currently, are still extremely low in real terms compared to history. And that's at a time that growth is definitely slowing, and we're just on the slide on the left, I'm showing the US manufacturing, and I'm using US because we still believe that a lot of what's going to happen around the world, and certainly what's going to happen in domestic South African markets, is linked to what's going to happen in the US and what kind of ripple effects are for the rest of the world. So, clearly manufacturing is slowing down. You can see after and that line below, essentially below 50, suggests that there could be a growth recession. Actually, in actual fact, last year, we actually did see a recession in the US. There were 2 quarterly negative quarters of GDP growth, which technically, in textbook, is considered to be a recession. In the US, it's not considered to be a recession because the US definition of recession is much broader. And the chart on the right, really, you can see on my right, on your right, is the grey bars are historical recessions, and you can see there that the difference between the 10-year and the 2-year US Treasury yield actually is a good indicator. Not perfect, 100%, but probably the best that the one you get, and that suggests that there's likely to be a recession. But the labor market is strong, and part of the definition in the US of a recession is when labor market or unemployment is higher than the long-term average. And you can see at 3.5%, despite the fact that we've had very aggressive policy hikes in the US, you still got unemployment at pretty much historical low levels. And I know there are different ways of measuring it, forward-looking, backwards-looking, and you can do all fancy stuff. The bottom line is it's a very, very tight market. It's loosening, but it's still, you well into the hiking cycle, and you can see on the right, that's kind of, and that's the chart on the right essentially talks to the kind of the noise or the reaction of the market last week to the surprise in non-farm payrolls in the US. But equities are off their highs, but they're not cheap. And what I look, again, here, the blue bars in this case is the recessions. And you can see that historically, when there's a recession, there's a significant hit on equity markets. What we've seen recently, to the end of 2022, has not been as bad as previous recessions. There's been some recovery. But despite that, on the chart to the right shows historical price-earning ratios, which is still above its long-term average. So you had, the economy is slowing down. There's likely to be further slowdown, probably to a recession, but yet the market is pretty happy to hold equities, which are going to come under pressure, we think, because earnings could come under pressure in an environment where growth slows down as well. You can't have strong earnings when the economy slows. And yeah, there might be arguments around momentum and all, longer-term momentum and longer-term themes, but from a cyclical perspective, it's difficult to see much more benefits from this and strong returns from equities, and particularly when you compare that to bonds. And my speciality is bonds, but it's nice to show this. But equities are expensive, very expensive globally, and while in South Africa they, as a standalone, not particularly expensive, against bonds, they are expensive. So in other words, when the squiggly line is below the dark blue one, and certainly when it's below the light blue one, that suggests that bonds are materially more attractive than equities. And in summary, for the view part, I will just say that inflation is slowing, but still high. Growth is slowing, but labor markets are tight for this late in the cycle. There's going to be a mild recession, we think, and therefore there's no rush to cut rates. This is not a Fed that's got the put. First we spoke about there used to be the Fed put, then there was what's the strike of the put. Now it looks very likely that there's not going to be a put, and the central bank is not going to need to basically come to save the markets. So valuation matters, and cash is an alternative, which is a big and important point to make. So the themes themselves are just very briefly, two themes on the fixed income. What we're doing in that portion is we like the short end of the inflation-linked bond market. We don't like the long end because we think there's too much interest rate risk in it. The short end is basically compensating you for inflation surprising on the upside, and we think while it, as I said, will moderate, it's going to end up being probably a little bit higher than the market's pricing in. And on the right-hand side is global. I mentioned the relative value of bonds and equities. Not all bonds are the same, and long-dated US bonds are not particularly attractive. So where we would focus on is more shorter-dated, where interest rate volatility is lower, so capital risk is lower, and you get very attractive yields, certainly compared to history. So I think it's important to think of history, in the case of Errol and myself, having lived through it, some of it, and for others, having read it in textbooks. But I think it's important to remember that history is not only the last 3 years. History goes back to much, much longer than that. In the equities space, again, very briefly, you'll get the presentation. We're looking for strong corporate governance. We're looking for experienced management teams, strong free cash flows, generation, and solid balance sheets. So these are the opportunities that we see, and this is the kind of exposure that we have domestically. Globally, using the same kind of approach, we're looking at a very diversified portfolio. Even though there are only 21 stocks in the global component, we are overweight China versus the benchmark, and a little bit underweight the US. Our preference is we think that the opening trade will continue for a bit longer, and there's still some reasons to believe that structurally China still offers good opportunities. And 21 stocks, but very, very diversified across all sectors. balance fund position, on the left, the chart, the red dots are the expected returns that I mentioned earlier from the different teams. The blue bars are the relative exposure to the benchmark. And you can see here that we are underweight domestic and global equities. We are overweight domestic bonds, overweight domestic cash, overweight global cash. Reason is because cash is now paying 4% in the US, 8% in South Africa, and that's a good option to have. I mentioned that we quite like offshore bonds. We are still, though, believe that we're better off being in offshore cash and offshore bonds as the market becomes kind of more accepting to the fact that the Fed is not likely to cut rates anytime soon. In fact, the surprise could be again on the upside. This is just the history of the fund holdings in different asset classes. We are quite active. The fund peaked at 84% domestic. We're now down to 68 and 32 in global. And that's basically partly to do with the change in Regulation 28. Our strategic asset allocation for global is 35%. We don't believe that 45% is the number that you want to sit at the whole time. You want to have 35%, and basically go around there. I have to finish off with 15 seconds to go. I think I've never done this before, got it in time, but this is a slide that I'm very proud to finish off with and leave you with, and let Errol take over with 4 seconds to go. Errol, thank you very much.
I'm going to speak about SAS funds, stable and defensive funds. First of all, this was not a fund. Anybody of you wants to walk out of here and go to the casino afterwards, this is the wrong type of fund. This is a stable fund. Our typical client, underlying client in this fund, is somebody who's a cautious person, and there are many people who are cautious, have seen their money disappearing in equity bubbles from time to time, even in fixed interest blowouts. They want a stable return over time. This is what we provide. It is particularly suitable, our fund, for living annuities and clients who are 50 plus, who are moving towards retirement. And for living annuity is great because you can draw down your 4%, even a bit more in income, and your capital should grow over time if we meet our target by inflation. So our objectives are CPI plus 4% per annum, but with lower volatility. We have a core of fixed income assets, and added to that, we have a maximum of 40% equities in terms of the CISA regulations. We do both strategic asset allocation and individual security selection, all done on the basis of trying to keep a stable type of return for our clients. So a company like Tongaat, Steinhoff would not be a suitable asset to hold for the fund, even if you thought it could double up. It was just too risky, particularly Steinhoff with his balance sheet. On the right, you can see my long-term track record as a manager of stable funds. I've been doing this for, I hate to say this, more than 30 years. And over that time, we have more or less kept to our targets. You can see the grey line on the right is a target, the benchmark of CPI plus 4. The blue line is index return on my stable funds over time. Probably one of the longest track records in this sector of the market in South Africa. So we have a core, well, not a core, we have a portion of the fund in equities, maximum of 40%. First of all, we look at, are equities generally cheap or expensive? Before we decide which shares we're going to buy, we say, generally, are shares expensive or cheap? If you look at the P ratio on the JSE, currently it is a little bit below its long-term average, so it offers reasonable value, albeit not cheap, and there are some headwinds, as we know, like load shedding, but nevertheless, the market is probably fair value. If you look at the USA stock market, I've taken the S&P 500. Now, there are other stock markets in the world besides America, but as you probably all know, the USA makes up over 60% of world stock markets by value. So you can't ignore it, it's dominant. And you can see the S&P 500, it's come down, the P ratio has come down tremendously, and it is now a little bit above its long-term average. So you can say, well, maybe it's good value. But this is historically looking. So you can see what prices are today. What's important are what earnings were last year, but what earnings will be next year. So you look at the ratio forward earnings to current prices. And I'm a chartered accountant I'm a lapsed chartered accountant. When I look at a company income statement, how is it made up? You start with the top line, that's sales, let's call it 100. Sales are under pressure in the USA in particular as the economy slows down. You then take off costs of goods, which are rising inflation, and particularly wages are rising strongly. So if you take sales less cost, you find that line is lower than you'd expect because of the pressure on cost, and particularly wages. That gives you pre-interest income. From pre-interest income, you take off interest costs to give you post-interest income. What's happened to interest rates? Well, as we all know, they've gone up tremendously in the States. There is a lag before the extra high interest costs come through the income statements, but after interest, there'll be further pressure on US company profits. And then I look at tax, and I think tax rates are structurally low around the world. There's more chance of tax rates going up than of them going down. So all in all, I think the pressures are there for American companies in particular for earnings to be lower rather than higher going forward, certainly in the short term. In South Africa, inflation is one of our big input components. We are trying to deliver our clients inflation plus 4. So we don't really mind if inflation is 4% or 6% or 10%. All we want to do is give 4% above that figure. Inflation looks like it's turning over in South Africa and probably will come down. So let's look at the next asset class, South African bonds. Currently, we can get about 10.6% on a 10-year South African bond. In America, that's about 3.6, 3.7%. So you're earning about 7% more on South African bonds than US bonds. We know South African bonds better than we know US bonds, so we say South African bonds relative to overseas bonds give you a higher yield and they're less risky because we know them better. If we look at South African government bonds, 10-year versus money market, there's a 3% or so pickup in yield. We like yield. Many of our clients like to draw off income, for instance, from the living annuities, so we think bonds give us a good yield. Inflation linkers also. I know there are different views, but at 4.6% on the longer term, inflation linkers, 4.6% plus inflation. So if you hold inflation linker, this is the longer term one, to maturity, you'll get inflation, whatever it might be, plus 4.6% per year. And that helps us achieve our objective. It's a core of our fund to give our clients inflation plus 4%. If you look at the States, we can see the green line there. Inflation in the States is turning over, coming off slower than expected. The red line is money market rates. They're picking up and probably will pick up further, even though inflation is coming down. Normally, you'd expect when inflation comes down in the States as it is now, that interest rates would come down. But because of the strong labor market, as Jonathan showed earlier, 3.5% unemployment, that's the lowest unemployment we had in the States since 1969. So the Fed has to do what it can still to push up interest rates. So I think American interest rates will continue to rise in the short term. If I look at a stable fund, we invest across the board. We're trying to give a stable return to our clients. We don't care if it comes from equities or bonds or inflation linkers or American bonds. All we want to do is give our clients a good return, inflation plus 4, in a stable manner. So we're not victim to any particular asset class. Equity, maximum is 40%, local and international combined. Currently, our local component is 24%, which is not as low as you might have expected, because we think equities in South Africa we can find, on a stock picking basis, we can find equities which we think offer value. Property is still very low. We've been nibbling a bit. Property countries like Fukili, which has great management and a good dividend yield. Fixed rate bonds, we don't usually go above 20%. We like to have internal limits, because one thing we found over time is even the experts get it wrong. So we limit ourselves to what exposure we have to any one asset class for our cautious clients. So at the moment, 20% in fixed rate bonds, the highest we go. Inflation linkers are 22%, a core of our portfolio. And a little bit in money market. Offshore, we underweight foreign equity for reasons I've given before. Foreign bonds, we're starting to nibble. We think interest rates in America will still rise for the next few months, but I think we can smell the end of the rising interest rate cycles, like when Noah from the ark sent out the bird to see if there was dry land, and eventually the bird came back with a twig in its beak to show that there was dry land. We're starting to look for the dry land of interest rates speaking in the States. It's not quite there yet, but we think it's going to be, when we send out the bird in a few months' time, it'll come back with a twig of optimism. If we look at our top 10 equities, we are stock pickers. We don't just follow the index in South Africa. So we find shares where we think there is growth and value. So APSA, it has tailwinds behind it. At this stage, the advances actually are growing reasonably well in high single digits on the loan side, particularly from investors who are looking at going into renewable energy. So there is some growth. Also, with rising interest rates in South Africa, they benefit from rising interest rates. As we all know, when interest rates rise, the bank's quick to push up the rates they charge the borrowers, but they take a while to push up the deposit rates. And the PE is 7. It's a good, solid company. Rembrandt, also high single-digit PE. It has some growth vectors. CIVH, the fiber business, you probably are only using their product, one of the biggest assets. They provide the backbone of the fiber connection around the country, connecting up the cell phone towers in the towns. Udoka Industry, one of my favorite companies, smaller cap side, came through with very good results a week ago, and a 7 times earnings and a good dividend yield of 6.5%. Forward, I like dividend yields. Share prices will go up and down over time, more up than down, but dividend yields are more secure. Mediclinic, we're just waiting. This did very well for us last year, up 50% in our portfolio. Unfortunately, Mediclinic's been taken out by MSC, so we're just waiting for that payout to come through. It's too expensive now to buy. Raynet Investments, that's Johan Rubert's investment company, trading at a 40% discount to some of its parts. Its biggest asset is Pensions Corp in the UK. Second biggest is British American Tobacco, but trading at over 40% discount to some of the parts, and doesn't have as bad a track record as some people think. Together, the coal company, 2 times earnings. It made record profits with a higher coal price. We have started to top it off for 2 reasons. One is the coal price has come off, but still quite high. And secondly, they're venturing into Australia. And we always worry about South African companies going to Australia. Speak to Woolworths for the David Jones acquisition, speak to Pick n Pay. So we've been topping it off. PP Cement, we think eventually we will have infrastructure growth in this country. It has to happen. We need dams, we need more power stations, we need better roads. Anyone who drives around Johannesburg sees the infrastructure is battling. At some stage, government will get its act together. Don't ask me when. I don't have a crystal ball, but they will, and PP Cement's product will be needed. Anheuser-Busch International Beer Company, and then Sasol are less than 5 times earnings. We believe that these shares show above average growth, and they are, on average, offering good value. If I look at the performance over time, this is the Sasfin Stable Fund, and you can see over all time periods, the Sasfin Stable Fund has outperformed the average of its peers. We always say our target is to do inflation plus 4. If our peers do something stupid or reckless or risky, we don't care. We're not going to follow them. But over time, we think with a conservative approach, we can beat our peers. And over time, over decades, in fact, we've averaged something like 2% per annum above the average of our peers. That is the Sasfin Stable Fund. It really has a place not for the gamblers who go to the casino, but for those that want stable returns over time. Thank you. Any questions?
Edel, thank you very much for that. Any questions from the audience? I've got a few. Right. Jonathan, maybe just quickly, one of our presenters earlier this morning made a comment on, how much further or how much more can the dollar gain in value, and we've seen some comments in the market as well. The dollar is structurally too strong. But my question rather speaks to your global bond exposure. We all agree that SA bonds are very attractive. You mentioned your presentation as well. global bond yields also attractive, but why then hold global bonds? Well, if some are of the opinion that the dollar might be overvalued.
So the way we approach a balance fund has got this whole issue around dealing with currency and conversion and so on. So our approach is one to basically look at long-term fair value of the rand against the dollar. And at current levels, we think that against the dollar, it's very important to point out that the rand is still slightly actually overvalued on a purchasing power parity basis. Now, that's not to say that the rand won't strengthen because against the dollar when the dollar weakens, because that's ultimately what happens. Our call on that for now is that actually the dollar's got legs to stay where it is. And yes, later in the year, it did take us a bit by surprise in the first month really of the year that the dollar weakened as much as it did. We think it will kind of remain resilient. One of the points to remember when it comes to a balance fund, we're looking for diversification as well. We don't know whether the dollar will go or the rand will go to 20 or 16. But we know that historically that having foreign assets has been a good diversifier. And therefore, the quant work that we do suggests that it still makes sense to be positioned in that way to give us our complete. We get a little bit like Errol, although it's a high equity and it's supposed to give you CPI plus 5. We're not trying to shoot out the lights. We're not always looking just for the returns. We're looking for the risk-adjusted returns here too. And I think that pretty much covers that. And what we will do when we really think that when that fair value kind of goes really out of kilter, usually 5% away from PPP, then we'll decide whether we probably hedge that back. In other words, keep the dollar exposure, so the global bond exposure, but hedge that back into rand to ensure that we don't lose out when the rand strengthens because we were in dollars.
Yeah, makes a lot of sense. On your global equity, and I mean, we all know Reg 28 limits went up. Your light in global equity explained why. But what are some of those triggers that you will be looking at, in terms of when one would want to re-risk on growth assets, especially global equity?
I think we need to get past the earnings revision cycle in the US for one, and to see corrections in the market, and to see that, Errol showed some slides, I showed the slide, to show that valuations are just more compelling to go back into those asset classes. There's also I think to the point there's maybe, and it says every cycle a few times, there are good opportunities in stock picking. It's not like it's all fall down. 42% in South African equities versus a 45% kind of strategic asset allocation. So, when those valuation measures suggest that expected return will be more appropriate to achieve our goals, then we'll revise and review and adjust.
Thank you for that. Errol, just quickly, in terms of your top 10 holdings, if we look at the JSE at the moment, again being dominated by Naspers and Process, and just about every fund you look at, you see Naspers and Process, and I had to look twice at your holdings. No Naspers, no Process. Your views?
Okay, first we do have a little bit of Naspers Process, Naspers mainly in the portfolio, but it's a small holding. One of our advantages is we don't have to follow the herd. We don't follow the index. We can do what we think is appropriate for our clients to achieve our objective of CPI plus 4.
Right, but no particular views on those specific stocks? Dislikes, likes?
On Naspers and Process?
Yes.
Okay, this is a tricky one. I think you buy Naspers, you're mainly buying Tencent, the Chinese, WeChat, WhatsApp equivalent. I think it's a great business, but the trouble is you are investing in a Chinese company subject to what the Chinese government wants to do. So I think the risks are high. So in a way, it is quite a high risk stock. I think it's a great growth stock. I find it easier to hold for my own personal portfolio than to hold for a portfolio like this where I'm trying to be conservative. Who knows what the Chinese government will do? At this point in time, the Chinese government is trying to stimulate the economy. So they relax some of the restrictions on Tencent, but that could change next year.
Thanks for that. Jonathan, very last question. You've got China exposure. You've showed it very nicely on your slides. I would assume, and I'm not sure, that it is Hong Kong H shares. Can you access A shares, and is there any meaningful difference if you can or can't access the A shares?
Eugene, that's a question that I'll have to refer to my equity specialist. I help with I do the strategic asset allocation, but the stock selection and exactly how we access, Craig can probably answer later as well if anyone wants to know. But we do have a healthy holding in the Naspers, and we also have a healthy holding in Tencent in our global portion. So we like the story. It's to a large extent a post-COVID recovery. Long term, we do realize that there are material issues around China, but for now, it's a cyclical call and a tactical call to hold those and overweight.
Thank you very much for that, Errol and Jonathan. Thank you for your time. Thank you for coming through today. Great presentations. Questions, sorry, from the audience. You want a mic, Pierre? Yes?
Can you hear me? Cool.
Yes.
Sorry, just got a question for Errol. Errol, the global exposure in your fund is quite low compared to your peers, with the limits being moved up now, but taking into account that increased global will increase volatility coming from the currency. Do you have strong views about what the range for global exposure should be in a low equity fund, in a stable fund specifically?
In total, we can go up to 45% in total offshore assets. My view has always been that if you live in South Africa, your clients draw an income in South African rands. When you introduce foreign currency, you actually introduce more risk in a way. It's different. If somebody says they want their kids to go to university overseas one day and they'll have to pay in dollars for that, then they should have a lot of money overseas in dollars. But if you're living in South Africa, you want to retire in South Africa, you're going to be paying your bill in rands. So I think for a stable type fund in particular, the bulk of the fund should be in rands. I would not be keen on going to, even though in terms of my mandate, I can go up to 45% offshore assets. I would not, for the fund, for a stable fund, be keen on going that high. I think 30% is as high as I would go in practice. But as I said, my daughter's studying overseas. For her, I've put dollars aside to completely fund her university education in dollars, and it's bloody expensive, I can tell you.
Good, thank you very much for that. I don't see other questions. We're unfortunately out of time. Gentlemen, thank you so much. Really appreciate your time here today.
Thanks, Jim.
Right, next up, we've got factor-based investing. Right. Some of you know, some of you may not know. We've all heard about different investment styles or different types of stocks in the market, and momentum and growth and quality and value and size. And I think we've all seen how managers, especially DFMs, try to classify this, and asset managers, some in particular, label themselves as well in those different categories. Sean, you want to come up so long? Colourfield, Sean joining me on stage from Colourfield. Just give me 1 second. Talking to factor-based investing, it's fine. Exactly. And how they manage that in their fund, in the Colourfield BCI Equity Fund, in partnership with Dimensional, and how Dimensional fits into the whole picture. Sean, thank you so much for your time. Great. And I'll move off the stage now. Thank you so much.
Thanks, Eugene. I'm only trying to be in front of the microphone because I think there's 7 speakers over these sessions, and I was the one with the short straw. So this is my microphone. I don't have it on me. I think I'm also going to do the cameraman an easier service because he doesn't have to follow me as I walk around the stage. So I'm going to stay put. This is a boot camp in factor-based investing. I'm not sure if you've heard it. There's no doubt you've been exposed to it. But the point of my session is really to get across a number of ideas. What is factor-based investing? What should you look for? Is it a panacea? And in fact, what it isn't. So the first thing is it's not a passive method of investment. If that was the case, I think I wouldn't be invited back. I'd get one session in, and then Tanya wouldn't send me the invitation to come back and present to the rest of you. But what it is it's a method of investing that's been around for many decades, but only more recently taken more prominence in the South African landscape. We use it as a core part of a client's investment strategy. There is the Colourfield BCI Equity Fund, and I'll give you a bit of a flavor of it today. So when it comes to factor-based investing, we wouldn't be talking about it without two individuals, Farmer and French. They are seen as the godfathers of factor-based investing. In fact, anyone in the investment world who looks at things academically would have come across Farmer and French. And what they identified many years ago is that the expected returns on stocks could be related to various factors that are out there. In fact, they said that every stock is going to move based on the market itself, based on whether it's small or large, or whether it's value or growth. And they were able to decompose returns down back in the 90s and come up with a seminal paper. It's called the three-factor model, and they explained the returns of stocks with these factors. As we sit today, there are over 450 published academic factors that are out there, and obviously a number of funds that talk to those factors. I'm going to take a step back. As Eugene said, I'm from a company called Colourfield. We're a liability-driven investment manager. And Colourfield, we often get asked why the name. And it's named after an art movement that started in the 1940s after the Great Depression. Lots of color, a way of seeing the world that wasn't so gray. As managers, it started in 2010. We felt that the landscape, at least with the pension fund investment managers, was very gray. And we came up with a new approach to invest for defined benefit funds. But what I like about this particular picture, and this is the Colourfield art movement, an example by Rothko and Gottlieb, is that you look at a picture like that, and honestly, my 5-year-old, she started grade R this year. If she came back from school today and presented that as a piece of paper to put on the refrigerator, I wouldn't be surprised. I'd be very proud. I'd probably point out that it's not quite in line. You know, we try and color within the lines. But this piece of art sold, you can see this is at auction. At this stage of the auction, it was $77 million. It actually sold for $87 million. And my point is that I would not be able to look through to the art to tell you why. Why would pieces of art that look like this sell for it? But it's on all of Rothko's work, or Gottlieb, these artists that are part of the Colourfield art movement. And I think that's the flavor when it comes to these factors. You can put them together in a fund. It's not always easy to see why they're going to produce the value, but you hope that there are experts out there that will make sense of it. I include this picture because for many years it stood in a gallery, in a famous UK gallery, hung the wrong way around until someone came in and said, no, this is actually back to front. You've got it vertical. Those lines are meant to be horizontal. So the ethos of Colourfield is an asset manager who goes back to first principles. We get our hands dirty with the academics. We're a team of many actuaries, makes for very pleasant conversation, very exciting. And we're the largest LDI manager in South Africa. We today look after 400,000 pensioners. We make sure that they get their paychecks every month, increases in line with inflation, and we manage over 50 billion rands worth of assets for them. But in doing all of this work, we've come across the fact that many people in defined contribution funds do not have enough assets when they get to retirement. This is a typical member statement. Somebody who might be 40 years old, they look at it, it says that you've got 136,000 Rand. You know, are you on track or not for retirement? And the reality is that most people don't know. And what we do at Colourfield is we take that 136,000 Rand and we turn it into metrics they understand. We'll say in rands and cents, how much are you on track for? You know, maybe it's 4,000 Rand, 10,000, what's your target, and how you might get there. That's beyond the scope of this presentation, only to say that in almost every event that we look at an individual who's not high net worth, people are well behind their own reasonable income expectations, and because they're not going to contribute more, because they're not necessarily wanting to work longer, the only way they're going to get there is with a good engine, and that's where equities come in. Although speaking to the bonds, it yields, real yields above 4%, it can form part of the toolkit, at least today, a bigger part. So we partnered with Dimensional Fund Advisors, a US organization, or at least headquartered, but they've got offices around the world. They manage more in these types of strategies, factor-based investment strategies, than anyone else around the world. They've got $585 billion US, but the who's who of academic or of academia work there. So we've got Farmer and French themselves are consultants to Dimensional. People like Robert Merton, who's done breaking work in corporate finance. People like Merton and Scholes, before Scholes passed away, was there. Before Merton Black passed away. So you've got Black Scholes, you've got Black passed away. You've got them working there. They came up with the pricing formula for derivatives. So all of these academics are there coming up with the best approaches. And as I mentioned earlier, you have over 450 of them. You've got amazing data available today, and you've got every academic wanting to publish in a journal. I know outside of this room, in this room, it seems like a very boring thing to do, to write up these papers. But if you're out there trying to get your name and you're in academia, what you're trying to find is the next factor. You want that data, you want to publish it, it goes into an academic journal. Asset managers along this type of strategy take that factor and they say, can we put it in there? And obviously you have a lot more of these funds becoming flavor of the month, because that factor generally does well for a limited amount of time and then it falls out of favor and you don't hear about it and the fund delists and you've got survivorship bias and it never gets mentioned again. So that's the problem with these factors, and you want to build something robust. So how do you look through the noise? I'm not going to leave this long enough for most of you to find it. I remember when I grew up as a kid, I could never see the picture here. I've never found one of these. They're called stereograms. They were popular, I think, 20 years ago. I've never seen it. Those of you that are looking at it, it's a shark. Okay, I can't see the shark, but there is a shark there. So with all of the data we have, we've got machine learning, deep learning. You literally throw data sets at the AI technology that we have today, and they will find the factors. You don't even have to come up with the reason why you think the factors are there. And these models, these processes spit out models to tell you this is how you should invest. And it looks amazing on a back-tested basis. Funds that would have outperformed in any market circumstance, because of course you can construct portfolios in sample, but you come out of the data, and now going forward, can it do it? Well, that's a different question. So one's always going to be very circumspect. There's a lot of stuff that can go wrong, a lot of things that sound great but aren't necessarily the case. For example, you might look at the data and conclude that if I buy a lot of ice cream, then I'm going to, when people start buying more ice cream, more people get sunburned, because that's what the data says. What you're missing is the fact that they happen to be very hot days, so more people were out buying ice cream and more people were out not applying, SPF 50. And then, of course, you could ask OpenAI, ChatGPT, what should we invest in? These are all the interesting things, and they throw out factors too. So Dimensional's long-term expected return checklist, these factors, and this is really what you should be looking at every time you look at a factor, is does it make sense? Why should something that is low volatility outperform something that's high volatility, or something that is high in value or pays a lot more dividends be better than growth? It's got to be a reason that's there. The story has to be there. That's often missed when you have the black boxes. It should be persistent, not just there for 1 decade, 2 decades. It should exist not only over multiple lengths of time, but in different geographical regions. It should be pervasive. It should be robust. If I change the definition slightly, does the factor fall away? So if I define value as high dividends or versus book to market, all sorts of ways of reclassifying it, does my relationship still hold? And it should be cost effective. Often when you try and trade stocks to capture a particular premium, it disappears because these January effects and that type of thing that are out there. So the dimensional philosophy, and this is something that they've tested over many decades, are to use 3 main factors. The one is size, which I mentioned earlier, which is Farmer and French's initial factors. The other one is price. You want to have high value stocks over growth. And the other one, a new one by Robert Noby Marks, and this has been tested quite extensively, is profitability. They found that companies that are making profits tend to continue making profits and do all the things that they're meant to properly. These factors don't generally appear over small periods of time. They are there for many decades. And you can see in the first column, the green one, the figures are a little bit difficult to see with the length of especially if you're sitting at the back. But you find that in all of the factors in South Africa exist. The size factor exists, the value factor exists, profitability. It becomes even more pronounced when you go to the US, even more pronounced when you go to the rest of the world, and then they exist in emerging markets too. The problem with factors is that they don't happen every single year. So you can find years that they're in vogue or out of vogue. This is an example of the factor that's most years we have the size premium coming through. Those are the blue lines above. But there are years where sometimes it underperforms. And so what you want to do is take multiple premiums, blend them together, and over time they materialize. So you can see that the probability of size happening in 1 year is 57%. Over 5 years, it's 67%. The same sort of thing with value. Over 5 years, 66% it will outperform growth, profitability too. And when you integrate them all together, over time, you're expecting over 90% of the time outperformance to come from those particular factors. So blending is key, patience is key, long-term over here is key. So that's the research side of these factor funds and where they're out there. And in fact, many professors who sit and are consultants to asset managers, they come up with these pieces of paper, they look good, the portfolio's there, they crunch the numbers overnight, the next day the stock sells and buys are there. But you actually have to implement this particular portfolio in practice. And here's where you've got to look at the trading side of things. You don't want to cross spreads. You don't want to be buying a stock that is falling. There's a momentum effect. We've seen that often, many times, momentum is seen as an underlying factor in the research. Momentum here is used in the trading of it. If you've seen a stock trending upwards and you've been given instruction to sell it, the trader has the authority or the permission to stop the selling of that stock and wait for it to go higher, and then when it's peaked, they can sell it. And of course, intraday, you want to make sure that your trading costs are kept to the minimum. So this slide over here just speaks to the momentum effect, which needs to be taken into account. So what we have over here is a BCI equity fund from Colourfield, which takes all of these dimensions. It's actually sub-advised bi-dimensional. They come up with the research to inform what stocks should go in based on these factors. And it's an equal blend of academia on the one side, the research that goes into these factors, which they are always looking at and seeing should they be updating it. And we often say, but we've seen amazing work that's come out of this, or these are what competitors are doing. And they say, we've seen that movie before. This is something that plays in many jurisdictions. It's temporary. You wait until it's permanent. Let's go back to these 5 checklists and see, okay, is it something that makes sense that it should be part of our factor-based research? And then trading, where the traders are equally given the ability to look at the market. In South Africa, even though we've got a smaller market, the relationships that you see on things like size are linear. So we've got a big concentration in the top 10 stocks, but your 20th smallest stock should in the long term outperform your 5th biggest stock. And so that relationship comes through. And even with only 60 stocks, we've seen a size effect come through. We've got broad diversification in the portfolio. Dimensional are very familiar with the South African market. They've been managing equities here as part of the emerging market mandates for many decades. And the track record over time has generated outperformance or alpha. This is not a fund that we look at on an annual basis, in the sense that these factors, as we've said, will have years that are working or they're not working, but overall they do tend to come off with outperformance, with alpha. We believe that this fund can perform a core part of an equity strategy. It's lower cost, it's not passive. It doesn't have the same amount of traders as, say, an active fund would have, nor the fees that go with active. Not all of these strategies are equal. So if you come across another factor-based fund, think about these things. The tendency is to think, wow, this is 10 factors, must be better than the fund who only has 5 factors or 3 factors. But this is what you're looking for when evaluating these types of strategies. And lastly, Dimensional are regarded as the leaders in this type of strategy, and Colourfield is obviously proud to be presenting or associated with that fund and be discussing it with you all today. So thank you for your time. Hopefully, if you hadn't heard of factor-based investing, you've got a better sense of it, and good luck.
Sean, thank you very much for that. Any questions from the audience for Sean? While the audience thinks, maybe from our side very quickly, we all know that value managers obviously punt the value story and tell you that it's the time for value, and so will quality and growth guys. But with your factor-based approach, do you ever deviate or lean towards any specific equity style or types of stock given different macro environments?
Yeah, so I think for us, we tilt on the factors. So some factors may be in or out of vogue. So if we can see it's not a great time for value, and it's not to say that we just blindly hold it there, but we're not going to change the philosophy and stop buying growth stocks at that point in time. Just water down the value part of the component. And of course, every stock that's on the exchange is going to have some allocation or measure of each of these characteristics. So every stock has a size, everywhere is somewhere on the value growth spectrum, and the same with profitability. So you're really trying to choose your stocks, overweighting certain of those features.
Makes a lot of sense. Any other questions from the audience? No. Sean, thank you so much. Very insightful indeed. The more often I see this presentation, the more it starts to make sense. Right, thanks, Sean. Right, our last session for the day, and top of mind of a lot of clients out there, is local equity. It's been doing very well over the past couple of months. And on any kind of value spectrum, doesn't matter how you look at SA equity, it looks very cheap. But also keep in mind, there's obviously a lot of risks associated with SA economy and a lot of the stocks that we hold. So I'm really looking forward to understand and to see how our next panel sees local equity. And I can come through to the stage along Louis Creer from 361 Asset Management, Chris Reddy from All Weather Capital, Charles Gous from Battelier Capital, Peter Armitage from Anchor Capital. Right. Quite a big panel. Thanks, Pete. Louis, yes, you can go first. Thank you so much for joining us, and looking forward to your presentations.
Thank you. I'm not going to stand behind the podium. It feels like something between us. We at 361, we don't work for the FBI, so we don't look at any factors. We are factor agnostic, as we call it. What I always find interesting when I come to these presentations is there's a place for all these things, and within our universe and the way we look at stuff, it's different than the way somebody else looks at something. But there's a space for good managers to make money in different ways. Let's start with the brag slide. That's our returns in our local equity fund. It's the second line there. Last year we had a wonderful year. We outperformed the index after fees by 5.9%. And that keeps in line with the past 3 years, which has been wonderful for us. It's, as I always say, past performance is not indicator of future performance, but we're very proud of it, and we're proud of the process that's gone into that and the hard work, and that's just an outcome of what we do every day. We've got multi-asset investments too, and that's not what we're talking about today. But if you follow BCI, you'll get exposure to those managers and a little bit more about those too. Then our hedge funds, another area we're very proud of. Last year, 8%. Yes, it's probably not the best in the market, but our long-term returns are intact. Our conservatism is intact, and our risk-adjusted returns are excellent. And if you haven't looked at our funds, it's now on most list platforms. And if you need any help, understanding hedge funds, we're always open. Just come and chat to us. It's a great diversifier. It's a great addition to most portfolios in bringing volatility down of the portfolio as well as adding performance. Today we're going to talk a little bit more about macro. I think a lot of guys before me have spoken about these things, but if they have connected the dots, I'll color it in a little bit. I'll chat about things that you've heard before, and then those I'll just flick through quite quickly and try and get to something new for you. Here's just a little bit of what's happening in China and US. Those are two big economies. In the US, we've seen over-indexing of spending due to stipends that have been handed out during COVID. They are still above trend if you look at their spend. We don't think that falls precipitously. The consumer there still has a lot of money. Yes, they have been drawing down on those savings, but those savings are still there, and we just think that will get back to trend gradually, which means lower growth from that side. Chinese, on the other hand, they've been saving. Last year, they've been locked down. We all know what it was like to be locked down, and they've got this cash on the sidelines. They've got about 3.5% of GDP saved up in excess savings. We think that kind of comes through this year. We'll see travel pick up, and we'll see a lot of consumption from the Chinese consumer. Then just jumping over to Europe quickly, what we've seen in the beginning of this year is the winter wasn't as cold as expected. Gas lasted them, and they still have a lot of gas. Yes, it's come down, and you start seeing that in inflation numbers. And as a result, also, growth numbers have been raised for this year. What we haven't seen is big industry. That's what we don't see in that graph is there's a lot of smelters that have gone offline, and those haven't come back. So what the real price for gas will be once industry comes back, we don't know. They're still trying to wean themselves of all energy from Russia. It'll take time, but they have their targets. There is risk to inflation from this just being gone. I think this is a structural story, but we'll see. It's hard to forecast, but we're keeping it in mind. In the US, we've seen the fastest rate hikes in 40 years. That's well beyond some of the lifetimes of some of the audience. Luckily, I'm in the over 40s, but I wouldn't say I've seen it. But we've seen a real tightening of conditions in the US. We haven't seen it come through in the economy as strongly as we expected, but these things always happen with a lag. We've seen the mortgage rates being the highest in 20 years. And once you've fixed your rate there for 30 years, it's fixed. So it's wonderful for the guys that fixed their rates at 2.5% a year and a half ago. They're styling. They'll never remortgage probably in those 30 years. What happens though is the new guys coming into the market now have to pay 6 and 7% for a new mortgage with house prices that are a lot higher than they used to be. So for new demand, it's just getting really, I don't want to say destroyed, but we love emotive language in 361. It's getting destroyed. Like new housing is a real problem in US. The same on the vehicle side. We've seen the second-hand vehicle market under a lot of pressure last year. Interestingly enough, the last 2 months, we've seen second-hand vehicle prices go up again, which is a little bit counterintuitive, as the rates are quite high, and it must be quite expensive to buy a new car and a second-hand car. We'll see how that kind of plays out and comes through into inflation. Our biggest worry in the US is margins and the effect of margins on earnings. We've seen input prices of all these companies going a hell of a lot higher than inflation, and the ability to pass that on is getting a lot more difficult as the consumers draw down on their savings. So we think margins come under pressure, and that leads to earnings coming under pressure. We've seen, about 3-4 months ago, you would have seen the US market, the consensus forecast for the S&P being at about $220 of earnings. That's now around 200. We think it could actually be lower as those margins normalize. Margins normally are mean reverting, and we just see a lot of reason for that mean reverting to come through this year as top line is under pressure, but your costs are still elevated. That's just demand in the US. PMIs are negative. It's just an indication of growth. We think that kind of continues. 50 is the level above, which is expansion. Below 50 is contraction. I think we hover around 50 for well into the second half of this year. Inflation is coming down. Yesterday we had a new inflation number. It is surprised to the upside. The expected 6.2 was still stuck at 6.4. The impact of that on the market is through rates, obviously. Coming into this year, the market expected 2 more hikes and then, two cuts again by the end of the year. So basically at the end of the year at the same rate that we were starting the year. Now we've had 1 hike and the market's basically close to pricing 3 other hikes again and priced out cuts completely. We were kind of the opinion that would happen, but the effect on the S&P and the market has been very muted thus far. The credit markets have moved, but the equity market hasn't moved, and we kind of struggle with that a little bit. But it's I think a combination of, as Eugene said, the most anticipated recession in history. Everybody's kind of positioned for it, but we'll see. When that actually comes through earnings, and the high interest rates come through earnings, it'll be interesting to see how the markets react. Labour market's still strong. We've touched on that earlier. That's just another view of it. Job openings. So there's still a lot of jobs, joblessness quite low. Then jumping over to China, what we've seen there, and that actually started not last year, but the year before that, is a big blow up in the property market. All these guys were pre-selling their property stock before they built it. Everything's on loan, and that imploded probably about 16 months ago. That's gotten worse into last year, and that hasn't recovered yet. We don't see a recovery in that this year, just because the economies, the Chinese government has tried to keep these companies afloat, but not try and support a lot of new investment into property. I think they've gotten a little bit scared. Yes, they want the current stock to come to the market, but the property market's not where you're going to see the growth in the Chinese economy. We feel it's going to be from the consumption side, as they were locked down last year, and it's just a bit of a rebound effect and excess savings coming back to the market. So you can see there's a lot of weakness in the property sector, and then a lot of loans now going into manufacturing and infrastructure, and I think combined with that into your consumer sectors. That's just credit in the Chinese market. You can see over time the total social financing has come down, so that's just an indicator of lower growth. I think the 2020s will be a lot lower growth in China than we've seen in the last 20 years as it is. The impact of that's also on our commodities, obviously, where they import a lot of our commodities. Then back to SA, the wonderful load shedding. I think everybody's seen this graph. I think, we don't get 100% in everything or anything in SA, but I think this year we might get 100% in load shedding, being load shed every day. Big headwind, and nobody likes it. But there's a lot of opportunity in that. I think the government's actually now they've come to a point now where they'll do anything to get this sorted out. Election years next year, they see it coming. The ANC know what the polls are doing. And the same with Transnet. We've just seen them break these things as government, and I think they're now looking for private partners to come in and help all of these things. And I think that creates a big opportunity when that turns around. The inflation in SA has, mainly been through push, not through pull factors. We haven't had a lot of demand in SA, so the inflation basically just comes from overseas. All these Ukrainian wars and stuff, and the impact there. What load shedding does is it creates a bit of inflation in SA through not demand, but supply issues. I think those will keep our inflation a little bit higher, but I don't think inflation is going to be a big problem. Just on the positive side, tourism is coming back. V&A at one of their best, one of their best Decembers last year. Everybody's still willing to come to South Africa. I think that's going to pick up. Load shedding is going to be a problem, and it's inflationary for all of us. We've seen Shoprite come out. They're annualizing, I think it was over R1 billion of diesel costs. If load shedding kind of continues like it was doing the end of last year, Pick n Pay annualizing over 700 million. For Shoprite, that's about 10% of their profit. Pick n Pay, that's about 30% of the profit. So it's very costly for businesses, and those businesses afford it, but the lower end is where the problem is going to be. So just quickly recapping, US, I think, whether it's a recession or not, we don't know. The Fed themselves have been notoriously bad at forecasting them. The past 3 recessions, they said it was going to be a soft landing. It never was. So yes, base case, we're saying soft landing, but you have to be open to the possibility that it might not be. If we come to the end of the year and the Fed has cut their rates materially, it would have been because of a hard landing, and that's not where we want to be. So hopefully it does muddle through, and we'll look to a soft landing. Then just looking at our SA equity fund, what worked last year, our banks overweight worked, underweight in retailers, so we had not a completely neutral, we were a little bit underweight on the consumer in SA, but it worked on the bank side and in the retail side with our over and underweight. Sasol and Tungela did quite well on the chemical side, and then our overweight in tobacco. Then underperformers, Mondi caught us a bit off guard in Russia, and then we were underweight food producers, and they outperformed the index, so we had a little bit of underperformance there. That's our longer-term track record. I'm just conscious of time, running out of time. And then just current positioning. The wonderful thing of the SA market, it's not an SA market anymore. So if you're in an SA equity fund, there's a lot of opportunity to buy companies that have virtually no exposure to South Africa. Prosus, Naspers, British American Tobacco, Sasol has a lot of drivers from overseas. Glencore, Richmond has no exposure to SA. Bidcorp, virtually no exposure. So all I'm saying is you don't necessarily have to go overseas to go overseas. You can stay in SA and still go overseas. We have a bit of a balanced view at the moment. We still like the bank, so we have a nice overweight in First Rand, ABSA, and then we balance that with BTI, which we think is still growing their earnings in hard currency in mid-single digits and trading on an 8 PE and an 8 dividend yield. 19 seconds to spare. I'm sure we're going to have time for questions now, but if we do meet outside, anything you want to chat about, anything you want to ask, there's no stupid questions, just come and chat. We'd love to have a bit of time.
Hi guys, I'm Shane Watkins. I'm the Chief Investment Officer of All Weather Capital. Now Robert Walton always introduces me as the guy that went to Australia for a month. And I just want to clarify that for you. Last January we immigrated to Australia and in February we came back. Now, I think it's fair to say that a lot of South Africans, including many people in this room, wonder, should we go to Australia? Should we go to New Zealand? Should we go to Canada? So I've been on your behalf. And I've checked it out, and you're doing the right thing staying. I can honestly say that I kiss the African ground every morning that I wake up. So, load shedding is a problem, but sometimes we only focus on the negative. There are many wonderful things in Africa, and there are many wonderful things in South Africa, and everyone in this room that has stayed has done the right thing. So, look here for performance of the funds, right? So we run hedge funds, and we run SA equity funds, and we run a global emerging market fund. Our SA equity funds, a 10-year track record, we're about 2% per annum ahead of the benchmark. The hedge funds have done very well. Our long-short fund, we're about 7% per annum above the hurdle rate or the benchmark over the last 10 years. And then our market neutral fund has done about 12% alpha per annum over roughly the same time period. So what is the unique competitive advantage of All Weather? And I think it's a combination of these three things. I don't know if you recognize a Venn diagram from grade 1 maths, but I think it's a combination of having a hedge fund mentality. I started out with the Peregrine Capital hedge fund. I was there for nearly 10 years. And a hedge fund mentality requires slightly different thinking. Then we have SA equity expertise, which of course is more of an institutional mindset. And then we have our global emerging markets team, guys that have worked in London for 10 years plus, that give us a global view. And I think that's given us our secret sauce. I'll touch on our market outlook. As some of the other speakers have said, for the last 10 years, the US market has been the only game in town. The US market cap as a percent of global market cap is about 65%, and the US economy as a percent of global GDP is about 25%. So the US is over-indexing, and these are long-term trends. It's likely that it will over-index, but probably not to the same extent in the future. What's driven this outperformance? Well, it's been US tech, right? So it's been 4 or 5 US tech stocks. If you strip those out, the US market hasn't really done that well. And they've benefited, as you can see on the left-hand side, from a perfect cocktail. Monetary stimulus, interest rates that were close to zero, strong fiscal stimulus. But now on the right-hand side, of course, we have emerging energy crisis. We have the Chinese regulatory clampdown. We've had the zero COVID policy, which has caused enormous harm to the Chinese economy. And I don't need to educate you on the war in the Ukraine. China has bounced, but we still think there's good growth in China. So the Chinese economy has slowed dramatically, particularly in the last years because of the zero COVID policy. Now, the implicit deal that the CCP, the Chinese Communist Party, has with the Chinese population is the CCP give them stability and growth, and the population allow them to be controlled. So it's essential for the CCP that they return them to a growth path and that they have stability. You saw how, in a way, the knee-jerk reaction to the social unrest, they abandoned zero COVID like in a highly unplanned way. So what the Chinese CCP needs to do is they need to get growth back into the Chinese economy. So they'll stimulate the way they can. The Chinese economy is a little bit different to developed market economies. The US economy is about 70% consumer, 30% fixed investment. In China, it's more kind of half-half, in fact, slightly less than half. So it's hard for them to stimulate the consumer. So they will go to the place that's worked in the past, which has been infrastructure spending, which needs commodities, which is good for South Africa. I think we've discussed South Africa being fairly cheap, and we're still fairly optimistic on a couple of domestic South African names. Corporate activity. So corporate activity, I think, is a very interesting part of our market at the moment. We've been particularly positive on the hospital groups, and I think you guys will have seen this morning, Life Healthcare have announced a number of unsolicited approaches for AMG. AMG is the imaging business in Europe. If they were to sell AMG, we think that Life Healthcare probably could add 50% from here. But I think the point is, wherever companies are persistently undervalued, eventually someone comes in there to unlock the value for you. So, you know, we've had on the left-hand side deals that have been announced, and on the right-hand side deals that we think could come. I won't go through them blow by blow, but I mean, we think that Sanlam in time is likely to take out Santam. We have no special knowledge here. It just makes sense given Sanlam's surplus capital. And it's factually true that they've tried twice before and haven't been successful. We've spoken a lot about Telkom and MTN and the value unlock if they were to sell OpenServe. Quilter, bottom left there, it's a UK wealth manager. The wealth management space in the UK is quite interesting. The top three players have about a third of the market. So it's a very unconsolidated market. So we think that there's a lot of opportunity there. Datatech, you guys know that business. They sold off Masons, which was a consulting business, at a very good valuation. There are two businesses left. And if they were to sell one, Jens has said there probably wouldn't be sufficient scale for them just to be listed with the remaining business. So if either Westcon or Logicalis are sold, it's likely that private equity will take out the balance. I think the point is that there are a lot of value unlock opportunities in the SA market, and some of them are corporate activity related. Our portfolio positioning. So I think we favor emerging markets over developed markets. Developed markets, mainly the United States, have had a great decade, but we think emerging markets from here will do better, particularly with a weaker dollar. You know, approximately 20 trillion of savings went into the United States from outside of the United States over the last decade. I think 14 trillion went into equities and about 6 trillion into US bonds. The US market's very liquid, right? It was easy for that money to flow in without a huge price impact. But when that money leaves, if it does, even a portion, the markets that it will flow into are much less liquid. So leaving the States won't necessarily harm prices there. But as that money enters markets that are less liquid, like emerging markets, they can have a big price impact. And so if you see the dollar weakening, if you see commodities being strong, if you think we're at the top of the interest rate cycle, we think money will shift out of the States into emerging markets, and emerging markets will be a great place to be. As I said, we overweight China. In China, we like the consumer stocks mainly. It's kind of the traditional, what you call the reopening trade. We're talking about the Macau casinos, the Chinese airlines. In South Africa, we like commodities. And then, as I said, we like the reopening trades in South Africa, which are mainly hospitality and hospitals. Obviously, in COVID, hospitals and hospitality did very badly. So now we're in things like Life Healthcare, Netcare, Spur, Sun International, Togo Sun, and so on. Within the commodity space, we favor Sasol. I mean, I think it's pretty obvious that it's cheap. And if you believe that the oil price is going to be supported at these levels or go up, Sasol is going to be a good place to be. About 8% of the world's oil goes into jet fuel. And Chinese international flights haven't restarted post the end of the zero-COVID policy. So we think that increased demand for jet fuel, the US rebuilding their strategic stockpile of oil, should support oil. We like some of the global market asset managers. We think 91 is a very good business. I bumped into Hendrik de Tooy at the airport the other day, and 30 years in, he's still as enthusiastic and passionate about his business as what he ever was. So I think, we're back in the jockey there. And then I mentioned, some corporate activity trades, which I think can unlock a lot of value. In terms of our fund positioning, we overweight financials, insurance, the travel and leisure kind of opening up sector. Media, we still overweight. I think I said two things to you when I spoke to you a year ago. I said, first, I've come back from Australia. And the second thing I said is, Naspers is the greatest investment opportunity in a decade. Okay, and the share price was about 1,500 then. It's doubled since then. So we still think there is some upside, but obviously most of the easy money has been made there. Underweights, we underweight retail, gold, banks, and so on. Just to talk to some of the specific overweight positions, Old Mutual just looks cheap. I think it's an unexciting management team. It's an ex-growth business. But, even the slightest sensible intervention should see, I'm talking management intervention, should see the share go up. Foschini Group, well-managed retailer. They've been quite successful with their offshore acquisitions. It's absolutely true that Australia has been a graveyard for South African retailers. Errol mentioned David Jones. He mentioned Franklin's. You can go back even further. Truworths owned a business called Sportscraft in about 2000, which actually went bankrupt. But Foschini bought a great business there. I've tramped around most of those stores with the CEO myself, and it's a very, very well-managed business. We've discussed Datatech, Sasol, Quilter, Netcare, Life Healthcare, Mediclinic. I think the hospital sector is ripe for unlock of value. Obviously, Mediclinic, the value unlock was last year. Life Healthcare has received an approach for AMG today. So, maybe there will be a Life Healthcare unlock. And then hopefully later in the year, there will be some kind of value unlock in Netcare. What is the reason to invest with all weather capital? So I'm not sure what's on the slide here, but the thing is, we're passionate about what we do, right? There's not a job for me. It's not where I come to try and earn some money. This is actually the thing that I want to do with my life. I'm passionate about investing. I think that the thing that was lucky for me in my life when I started out my career, I started out like Errol did in the 90s at Liberty Asset Management. And the truth is, some of South Africa's greatest fund managers came out of that cohort of people. Dave Fraser or Clive Nates or Errol Scher or Andrew Kingston or Roger Williams. I think it's incredibly lucky if you can start out your career with passionate, competent, smart people. And that was, I think, a lucky break that I got when I started out my career. So we're very passionate about what we do. We're very driven. We were given a slot as a boutique manager. We don't see ourselves as a boutique manager. Our business is about 20 billion now, and we see ourselves more as a subscale mainstream manager. Our ambition is to grow this into a 100 billion business in the next 5 years, and we will. So just concluding, fairly good performance, a clear process, a very good team, very experienced now, and I think a very strong focus on risk management. So with that, thank you very much. When you wake up in the morning, recognize how lucky you are to be in South Africa and in Africa.
Thanks. Good afternoon, everyone. Yes, you've made it to the afternoon, so well done. We're almost done. I'm Charles Gous from Battelier Capital. I'm here to tell you about our business and about the Battelier Long Only Equity Fund. Sorry, just want to get which way? This way. There we go. Okay, so the business was founded in 2004 as a hedge fund management company. We've got a very strong focus on capital preservation across all of the funds that we manage. There's a consistent investment process, so we do the same thing in the different funds that we manage. We don't want to constrain ourselves to a specific investment style, so remain flexible. I think it's also important that we're an independently owned business, where 100% of the equity owned in the business are by those of the staff that work at the business on a daily basis. We're not a large manager, just under 11 billion rand under management, so that allows us to actively participate in various areas of the market. If we look at the long-term track record of the funds we manage, I firstly want to notify you that we've got longevity in the products that we manage. Funds starting in 2005, 2008, 2010, 2012. All of the funds have outperformed their benchmarks, as well as the JSE All Share Index over time. In addition, where the capital preservation funds, the long-short fund, the market neutral fund, and the flexible fund, has done so at considerably lower volatility than the JSE. I would also like to point out that we've never closed a fund. So what you see on the screen is what we've done since 2005. So when we engage clients or prospective clients, the same question always comes up. Can you expect credible returns from SA equities? These businesses operate in a very, very challenging economic environment. SA GDP growth has been below potential for a very long period of time. We know about load shedding and the impact that's had on business activity. According to this chart, Standard Bank estimates that just load shedding has curtailed SA GDP by 2% in 2022. Transnet has failed our commodity exporters, poor service delivery, crumbling infrastructure, corruption and state capture. Certainly doesn't paint a pretty picture. However, we would want to argue today that this low base provides a very favorable starting point for SA equities. The market, in our opinion, is largely underinvested. Domestic investors have allocated offshore, while foreign investors have been net sellers of SA bonds and equities for pretty much the last 5 or 6 years. So it's not surprising that equity valuations are very low relative to history. Some of our peers here have also talked about the very high bond yields, so I won't dwell on this chart. I think this next chart is very important as a further support for low valuations of SA equities. If you look at the red line, that's the level of profitability of SA companies in South Africa. It's well below trend and looks a lot like the start of the year 2000, which was a very favorable time to invest in SA equities. Yes, I mean, we will agree that obviously there's a couple of other headwinds in the way at the moment. I think it's also important to look at the blue line in this chart. That's the profitability levels of the S&P 500 over time. It's never been as high as it is currently since the year 2000. We would caution in extrapolating those levels of profitability into the future. So, for us, when we look at the opportunity in SA equities, we're operating in an underinvested market with very low valuation multiples and profitability trends that is well below the norm. So let's get on to the next question. How was the corporates done in this environment? So we've listed a couple of the companies that we own in the SA Equity Fund and their 5-year compound annual growth rate in their earnings. The banks have grown earnings at 4 to 7%. Some of the retailers have grown between 3 and 5%. Bidvest has done a bit better at 8%. All the while, you as a shareholder received a very decent dividend. If you combine the two, economic interest for you as a shareholder was at least double digits over this 5-year period. So in our opinion, investors have the opportunity to buy some of the best companies on the JSE currently, trading at very low valuation multiples. This is best viewed if we look at the long-term history of some of these companies. On the screen, we have Standard Bank. Standard Bank has grown earnings from 7.40 Rand in 2010 and is expected to deliver around about 20 Rand in earnings for the financial year ended December 2022. It's consistently paid you a dividend, currently yielding 6.7%. However, if you look at the chart on the right-hand side, you can see what's happened to the valuation over time. The valuation is pretty much at the lowest level since 2010. So the business has done its job, it's grown earnings, it's returned cash to shareholders, yet PE ratios have decreased significantly. You can also view Bidvest in the same way. Bidvest has grown earnings at 7.6% a year. It's consistently paid you a dividend, yet it's trading at a below average multiple. Multiple is a little bit higher because of the international expansion in their services division that attracts a higher valuation. If we drill a level down to the mid-cap companies, so this is an area where the fund is also very active, we see even more impressive results, with some of them delivering double-digit earnings return, compound earnings return for the last 5 years. Also, we would point out corporate action potential in this basket of stocks. Adcock is majority owned by Bidvest. Makes perfect sense for us, for Bidvest to take out the rest. Caxton has acquired close to 35% in Impact and has publicly stated they want to control the business, while we think ACI will make an excellent acquisition for an international chemicals business like Yara or the likes. Again, let's have a look at what they've done. I think this is the question I'm trying to answer here. How has the companies done? This is Udeco. One of the previous presenters also mentioned this company. Earnings have grown from 8 Rand in 2010, and as they've produced record earnings in 2021 and 2022. We expect them to again grow earnings in 2023. They've consistently paid out a 50% dividend. It's a highly cash-generative business with very limited capital requirements. Yet the PE multiple is at an all-time low. So the business is buying back stock. It's creating shareholder value. We can look at Italtile in the same way. Italtile has grown earnings by 13.6% since 2010. By our calculations, this is the best performance of all listed retailers in South Africa over the same time period. What's quite interesting here is if you look at the blue bars, that's the dividend. You'll see frequently that dividend spikes up. This is as the company pays you special dividends in addition to the normal dividends, because it's a highly cash-generative business with no debt on the balance sheet. Yet, look at the valuation multiple on the right-hand side, all the way down to 9. So it's a very good environment for us as valuations are low and earnings are still growing. So I think that comes down to the last point. How has the fund done in this environment? Our fund has had a good performance in 2022 and 21. The longest running Battalier segregated mandate, which started in May 2012, just over 10 years, is compounded at 12.3%. But I think this last slide will really answer the question, can you generate decent returns out of SA equities? The Battalier Equity Fund is up 46.5% on a combined basis for 2022 and 21, ahead of the capped SWIX and SWIX, but importantly, when measured in Rand, well ahead of the S&P 500 and the MSCI World Index, which delivered 22 and 17% on a comparative basis. So where are we seeing opportunities? This slide looks a little bit skew. We run a high conviction portfolio. There's currently 30 positions in the portfolio. There's 5 key themes where we can put money behind. We are quite comfortable to actually have more funds in any of these 5 themes, but we're trying to spread it out. Firstly, within resources, there's an opportunity to invest behind the companies that will benefit from the greenification of the country, of the world. What is quite nice is that all these businesses are trading at very high free cash flow metrics, and they've shown capital discipline. So the management teams, rather than adding capacity, have returned cash to shareholders either through dividends or share buybacks. We favor the banks within the financial space. We think the banks will produce credible earnings growth in the next couple of years, accompanied by very high dividend yields. The mid-cap exposure in the fund is a clear portfolio differentiator. These companies are executing extremely well, and there's M&A optionality. Within quality industrials, we have the opportunity to buy some of the best companies in the country. These companies are expected to continue to outperform their peers in a tough economic environment and also attract significant shareholder interest should things turn more favorably. There's a number of companies on the JSE within the value unlock space, trading at deep discounts to the net asset value that can produce material gains for shareholders. More than 80% of the fund is invested across these 5 key themes. So I think in summary, In our opinion, global capital markets face an uncertain period ahead. Slowing growth, delayed effects of less accommodative monetary and fiscal policies will take its toll. Domestic capital markets continue to trade at a deep discount and offers attractive investment opportunities. In our opinion, the risk is more towards a re-rating than a de-rating from current levels. If we look at the fund, it's invested in quality companies, trading at low valuation metrics, where we can see earnings growth and healthy dividends into the future. So we are very encouraged about the wide opportunity set we have available on the JSE and continue to see numerous opportunities to deploy capital. Thank you very much.
Okay, good afternoon, folks. I've met a lot of you guys in the audience, and it's nice to see you all again. One of a few opportunities over the course of the last few years to have some physical contact. So yesterday I was on Business Day Television, and they asked me to come up with 3 Valentine stocks, which I thought was rather a novel but not particularly factor-based, well, probably very factor-based investing type approach. So I phoned my wife to ask her to watch it, because I thought she'd probably be the only person watching. And I chose Richemont for jewelry and watches, Sun International for its hotels and the like, and Spur. I got off the line. I thought I'd done pretty well. There was a WhatsApp for me saying, I'm happy with Richemont, but if you take me to the Spur for Valentine's Day, it's all over. So we're going to try and add a bit of value today. It's nice to talk after my esteemed colleagues and peers in the industry have talked. I can focus on some of the things that they haven't talked about. The news today, for all of you to realize, is that almost all of us up here are completely wrong, and if that's judged by history. If you go back 12 months ago, if you remember, inflation in America was going back to 2%. The inflation spike was transitory, and there wasn't one big global investment bank that was talking about interest rate hikes in 2022. Roll forward 1 year, inflation had peaked at 8%. Interest rates had gone up the most ever that we've heard, as we've heard today. And we're sitting much accelerated into a cycle. And the economic cycle is now looking like it's reaching the end of the interest rate cycle as opposed to the beginning. So our ability to confidently predict exactly what's going to happen with macro events is fairly limited and on average wrong. That then boils down to stock picking, being in quality businesses, and being in companies that we can understand and move forward with. I'm not really talking much about macro today. This is about SA equity. And I'm sure most of you, because most of the people in this audience deal with private individuals and people who've got money to spend. And you're sitting at home and at 6 o'clock the light goes out, and I'm sure you all get the phone calls saying, just get me out of SA equity. And if you go back 12, 24, 36 months ago, it always felt like that. But ultimately, if you look last year, it was 100% the wrong thing to do. The answer is to be diversified. If you were sitting in global indexes last year, you went down between 10 and 30%, depending on the type of shares you were invested in. And in a reasonable SA equity fund last year, you would have been up between 5 and 10%. So with South African expenses, it makes sense to be invested in some SA equity funds. And also the key question is, guys go, SA equities equal the SA economy. And I'm going to put up a few slides. Guys like I say it all the time, but we'll give you some of the facts and figures. And if people talk to you about SA equities, the first question is not how is SA doing, it's how is China doing, because it's got a much bigger influence in the SA market than China has. From an anchor perspective, our philosophy is finding quality long-term compounders that we want to hold for long time periods. And we look at the business and investments and question whether they're companies that you would want to own in your own name over time. You're not going to buy a bad business because it's cheap. You can buy a business that's reasonable, that you think you can improve at a good valuation. And that's kind of underlying what we talk about. So strong quality buyers. So breaking it down into how do you answer the question, should you be in SA markets? Number one, the Chinese factors, as we've heard from lots of people today. And again, everybody being wrong. If you look back to September last year, it was in fact at the Chinese October 2022 conference, Jinping came out and said all sorts of things that weren't market friendly. we actually got a report from JP Morgan, which detailed exactly why China was uninvestable, putting sells on every single share that was out there. And perhaps not surprisingly, another report came out from JP Morgan 2 weeks later from a different analyst saying that, in fact, you could buy China. And the first analyst appeared to now work somewhere else. So there's lots of forces behind the markets out there. Only 3 or 4 months later, many Chinese shares up 100%. Naspers and Prosus are up between 80 and 100%, and they say it's one of the biggest crowded trades out there. Why is that? The COVID opening up, and there's a playbook that we can all follow. When America opened up from COVID, or the other countries, some predictable behavior follows. People do revenge spending, they spend money on experiences, they've saved up money, and the Chinese economy this year will grow about 5.5% to 6%. The expectations for this year, if you look back only 6 months ago, were in the region of 3 to 4%. So that helps our commodity companies. China consumes roughly 60% of all the commodities around the world, and it's singularly the most important thing for the commodity economy. We've then obviously got Naspers and Prosus, which is 70 to 90% Tencent, depending on how you want to value the residual of the business. So it's a massive Chinese factor. And then there's a Chinese factor that's a phenomenon across a lot of our businesses, like Richemont, the Chinese traveling and the Chinese expenditure on luxury goods is amazing. Then when we get over to, so the commodity companies, we now then start to overlap with South Africa. So we're not that wild about the commodity companies that have got South Africa as their manufacturing base. So a company like Thungela, which a few of us have talked about, probably one of the big differentiators between equity funds last year was whether you caught that few hundreds of percent in Thungela. We think the easy money's been made, and we think we actually don't own it anymore after benefiting quite nicely out of it. But every year they're having to lower how much they can export because of Transnet. So the same with the platinum shares, which we do own some of. We're very anxious about load shedding. At stage 6, what they can get out the ground simply is very, very challenged. But the other commodity companies that have got global exposure, we're a lot more positive. Then when you get through to SA, there's some very exciting opportunities. There's some great businesses, and there's lots of management teams and phenomena where you can benefit from the tough times out there. But we are consciously avoiding companies that are relying on South African GDP growth. So right now, today, inflation sits at 7 to 8%, but our kind of benchmark for a company to grow its profits is it's got to grow its turnover by over 10%. Because there's lots of things that aren't captured in that inflation number. And something like a Pick n Pay, which should make about 2 to 4 billion rand operating profit, 1 billion rand spent on diesel is hugely significant for the business. 2 other companies that come to mind, one that came out with numbers the other day, which is Curro. Their student numbers are only at 3.3%, absolute disaster. They've built a capacity where that should have grown by 7 to 8% per year. They've got lots of parts of their high schools where in standard 6, where you can tell somebody's age where they say grade 8 or standard 6. So I'll stick with standard 6. Lots of guys coming through the schools, and that should have increased by 8%. But parents are now not putting their kids in grade 1, and they're saying, let's start with a government school and put them in a private school later. We don't like a business like Netcare. Netcare's got 60% of its buyers, basically one company. Discovery's got 60% of the market share out there. From a medical aid point of view. So massive buying power. They have limited price increases from hospitals at 6%, and nurses' salaries are going up significantly more than that. So the hospital companies, Netcare made R1.60 a share pre-COVID, and we think will make less than R1 this year. So it's one of those companies that just hasn't been able to catch up. So unless you can kind of get to that, Curro, 3.3% learner numbers, 6% increase in fees, 9% is just not enough. So there's lots of companies to stay away from in the SA market, we think, but there's also lots of businesses that benefit. From a solar perspective, last year, apparently, enough equipment got imported into South Africa to create 9,000 megawatts of power. To put it in context, Eskom has a capacity of 46,000 megawatts, and they're currently able to produce and deliver between 23,000 and 27,000. You'll know when it's 23,000 because it's pretty dark at that stage. But, adding 9,000 onto it, that's not necessarily the case. That's going to go into solar panels that aren't used, etc. But the private sector there's massive opportunities coming up over the course of the next few years. And South Africa really relies on the private sector picking up where the government has failed, and we think will continue to fail. And there's kind of a strange recognition of that in the government, and certainly the noises over the course of the last few months in terms of privatizing and giving the private sector the opportunity to invest is big. Solar is also quite big for the banks, the financing side of it. So in all the turmoil that's out there, there's some opportunity. Just a few slides to put the SA market into context. So we all talk about our share picks, and it's quite sad really, because we love global investing. There's 6,000 shares to choose from. In SA, the market's become a lot smaller. And this shows you that the top 40 index as a percentage of the JSE All-Share Index is now 86, 87%. So you really are judging our ability to invest in the right shares in the top 40. From an anchor capital perspective, we've got 2 equity funds. We've got an equity fund that's almost 10 years old, which also has between 20 and 30% foreign in it. And we recently launched just an SA equity fund. To just reflect the SA portion of it. Our business has got about 105 billion rand of assets under management. We started it about 10 years ago, and we've got an investment team full-time of 20 people looking at asset classes all over the world. So, when you look at South Africa, it's a lot more limited. The tradability has come down. If you wanted to trade every share on the JSE, going back to 2002, it would have taken you 550 days. It'll now take you 750 days. The number of listings has halved. So, as you can see in the slide on the right-hand side, there's delistings every year for the last 6 or 7 years, and the number of listings has gone from 600 to 300. The sell side is almost halved. So the active brokers in South Africa has gone from 60 to 30, and South African GDP growth, we think we're into a 0.5 to 1% angle. But importantly, and coming back to the point, the SA equity market isn't really buying South Africa. The percentage of profits from emerging markets, excluding South Africa, so in our market, international profits are 77% of the SA market, and SA is only 23%. Breaking that down, international emerging markets are 62%. So there we would include all the resource companies, Naspers, Prosus, the portion of Richemont, the portion of British American Tobacco, etc. And then international developed markets, 16%. So the driver is not the SA economy, although there are opportunities in it. In our top 20 shares, I've simply put a red dot next to the shares that are driven by China. And you can see the extent to which that prevails. I'm going to run out of a bit of time. I want to move over to our actual slides and shares. So we are able to construct what we think is a pretty attractive investment portfolio in South Africa. If you go through our top 10 shares, only 3 of them have South Africa as a driver, but we're actively looking for the opportunities for companies to take advantage. And a few that I wanted to highlight there in the yellow, Afrimat, which is our 3rd biggest share, that's simply a call on management. It's a management team that we've followed in various guises over the course of the last 10 to 15 years. And these big, often, things have been mothballed, or these big commodity companies, sell-off companies, and a sharp, agile management team can double the value of it pretty quickly. And they've done that, and we think they'll continue to do it. Bidcorp, I think, is our classic quality compounder and the kind of company that we're looking at. We love its fundamentals. It's benefiting remarkably from people going and dining out and a rebound in what's happening out there. Much lower down, we like a company like Advotech. We said we didn't like Curo. Advotech, we like their story and nice annuity earnings. But a smaller one, which you've got a pretty small stake in, and if I was to buy, the only share I bought for my kids in SA over the course of the last 6 months is Stadio. And the story is quite simple there. It's the biggest private distance education business in the country, with about 56,000 students. Its main competitor is UNISA. And if there's somebody you'd really like to compete against, it's UNISA. For any of you who've had any exposure to it, and I see it anecdotally across our business, they've got 300,000 students, and it's a complete mess. So we think Stadio can take its 56,000 students on a distance learning basis, probably to around 80,000 over the course of the next 3 to 4 years, and they can grow their profits at 25 to 30%. It's a company that generates probably 90% of its profits in cash. As you can appreciate with distance learning, you don't have to build a new classroom every time you want more students, and they make a 40% operating margin. So a fantastic business. We don't go to massive stakes in small cap companies in our business, but that's one that we continue to build our stake in. And then you've got companies like AECI, a few of the other guys have mentioned it, and there's a lot of good quality companies that are trading at very low multiples in South Africa, where the fundamentals are good. We go and look at companies to make sure that they're not victims of low SA GDP growth or the circumstances that are out there, but they can be beneficiaries of it. So we've delivered nice returns for investors. I haven't put up all the performance slides. I think across our group, we nominated for 3 or 4 of the different awards that are out there. The one thing that you should never do is buy a fund if it's just won the award. You should probably buy it 2 or 3 years later, which hopefully is the case. But that's our outlook for the SA market. There are opportunities. We've been bullish on SA and global markets at the beginning of this year in our kind of strategic outlook. We've had quite a bit of that return already, but there are underlying companies and shares that we'd be very happy to be invested in. Thank you.
Thank you, gentlemen, for that. Any questions from the audience for the panel? I just want to check, are you all joining us for lunch outside? If you have then questions, like Louis mentioned as well, you're more than welcome to have a couple of discussions with them. I see Robert's got a question at the back.
I don't have a question, just more a statement. You may wonder why is Shell, what is he doing on our stage? He's a bit of an intruder, but he's a very welcome intruder. He's joining our club of equity specialists in May this year, and we're looking forward to establish the Bateleur SA Equity Fund with him. As you know, we've got some awesome equity managers, like we already can see in the team there. I think we need one more, then we've got a full rugby team, and then we'll be happy. Thank you, and welcome.
Thank you.
Thank you very much for that, Robert. And thank you to our panel as well, Shane, Louis, Cheryl, and Peter. Thank you very much for joining us. Just a couple of notes of thanks very quickly before we break for lunch outside. To all our presenters today and our panel here, thank you very much for all the great work you've done and getting all this stuff together, to the BCI marketing team and the sales teams for putting this event together. And last but not least, to you, the audience, for your continued support. I've mentioned it before, but again, without you, we are absolutely nothing. One last reminder, we've got our 1 March online Global Manager webinar. Remember to attend that, and then we'll be back to the usual boutiques on Wednesdays. But again, thank you very much. Please join us for lunch outside. Thanks.
Thank you.